before Silver
Best
Creek.
decision of his life.
According to Alicia, that's true.
Next to his wife and children. That's like right up there.
So I run the 1031 exchange department as well as the foreclosure department, kind of the lender services department. And then I also serve as general counsel, so I handle all title and escrow claims, which we don't like, but they do occur. And then underwriting, just generally, how do we get this transaction closed? What do we need in the way of documentation to mitigate risk and get comfortable with closing this? So those are kind of the calls that I get throughout the day. I like these classes to be pretty interactive. If this group has never sat through it, I can sit here and talk for 4 hours about the tax code, but that's not going to be a lot of fun for anybody. So I don't mind questions. I've taught this class enough that I don't mind skipping around, and I promise you we will. I will cover so much just off of this slide that we will skip through slides moving forward, because hopefully you guys have questions as we go on these definitional terms, and we cover them in depth, and therefore when we move forward and I have another slide on basis or gain, I skip it because we've already covered it, okay? Every slide up here is in front of you, so if you have trouble seeing that, you can just follow along in your handouts. You can take the handout with you to have it with you as you go. I went to school at UW, where I did undergrad. I went to grad school at Gonzaga. My grandparents and parents are from Boise and Nampa, respectively. I've been in the Valley for about 20 years. I practiced law for, not quite 3 years before I realized I hated it. Keeping track of your time in 6-minute increments is about the worst idea somebody could have ever come up with. And then fortunately, we did a lot of work with the developer of the Bridgewater subdivision, and he used Pioneer Title, and so I got to work with Pioneer a lot, and it was just kind of a natural transition when my predecessor retired. So with that, we'll go ahead and get going. Now, we're here today because you get free CE, which is nice. More importantly, your duty as an agent in the state of Idaho. So if you look up the statutory duty of a realtor, is to use reasonable skill and care. Okay, that's the standard. It's not a fiduciary duty. Okay, attorneys and accountants and doctors owe a fiduciary duty, which is kind of the highest duty you can owe to somebody. Reasonable skill and care, middle of the road. It means you need to know a little bit about everything, but you don't need to know everything about one thing. Okay, you need to know what a 1031 exchange is. You don't need to know everything about it. Okay, most of what we're going to cover today, to be perfectly honest, 95% of what I think you need to know as agents today, we're going to cover just off of this slide. By the time I go through all these definitional terms and finish and we take our first break, you're pretty well covered, okay? But I do think an agent owes a duty to any client or any customer to know what an exchange is, when it can be used. The moment you say, oh, you're listing a rental property, this qualifies as a 1031 exchange, have you considered that? And they say, I have no idea, what is that? You can simply say, I have no idea either, but let's put you in touch with somebody that does. Let's call your CPA, let's give an accommodator a call. But at that point, your duty's been satisfied, right? You don't need to know everything about the tax code. You certainly don't need to know everything about 1031 exchanges. You just need to be able to issue spot, okay? Is this an opportunity? Is this a tool that can be used in this transaction? And then once you indicate, have you considered a 1031 exchange, you make a note of that in your file, and I think your duty's been satisfied. I mean, beyond that, about whether it's worth it to do an exchange, that comes down to somebody crunching the numbers on what is the tax consequence, okay? So with that, we'll get started. Okay, Section 1031. If you open up the revenue code, and it is a very thick, very boring blue book, and you go to Section 1031, or you go to the supporting rules and regulations in the back for Section 1031, here's all it says. If you own a property for investment purposes, or you own a property that's held for productive use in a trade or business, this building for the Silver Creek Brokerage is a building and trade or business. Pioneer Title owns a lot of real estate. We actually lease the Guild office off South Eagle Road. That's the Guild mortgage office is a trader, or is an investment property, right? We rent it out. Right next door, we have our Meridian office that we own, and that is a trader business office, okay? So investment property or trade or business property, upon the sale or disposition of that property, you can elect to defer tax. We're not excluding, right? We're pushing it off. We're kicking the can down the road. That's all we're doing. You can defer payment of tax so long as you buy other property held for investment purposes or held for productive use in a trade or business. Okay? Now, that's really all it says. I mean, we could probably break now and then you could leave and just say, okay, I think I know everything about exchanges. Here's how I define it, and here's how I want you to remember it. Your clients can 1031 exchange out of and into any interest in real property, right? Think broadly. Any interest in real property other than a primary residence or a second home. Okay, if it's for personal use and enjoyment, it does not qualify because it's not held for investment purposes and it's not used in a trade or business. Every other type of real estate qualifies. I'm here to tell you, there's one other type that we'll get into later, and it's called inventory. And if you take Corey Barton, right? When Corey Barton Homes goes out and they buy land and they subdivide it and then they improve it and then they build vertically on it and then they sell a finished product, that's inventory, right? Corey holds houses like Corwin Ford holds vehicles. It's just inventory. So when they sell a house at a profit, that's their income, right? That's how they make a living. So they don't get to defer their income tax. We're talking about capital gains tax. We're talking about investment property or trade or business property. So if it's a primary residence or a second home, it doesn't qualify. And then if you're also a developer builder, any inventory you have doesn't qualify. Everything else in Idaho or this country that is transferred by way of a deed qualifies. Everything. Okay?
So
Yes.
the property that you're changing, that person is changing that to has to develop income?
It has to generate income. It doesn't have to. I mean, I have clients that 1031 exchange into land, raw land, and they just bank it.
Yeah. Okay.
They're land bankers, and that's an investment purpose. So it doesn't have to generate income. If it's if it's a rental property, it's a residential dwelling that could be rented out, I would argue, why are you not renting it out? And the scenario usually comes down to, I have clients that are selling an investment property in California and they want to relocate to Boise or Eagle or somewhere thereabouts. So they want to purchase a home, but they don't want somebody to live in it. They just want it to sit vacant. And can they do that? If they're comfortable with it, I don't care. I don't prepare their tax return and I don't sign it and submit it to the IRS. I can tell you it's a lot cleaner to prove your intent if you actually hold it for investment purposes by renting it out and showing some passive income on your tax return. That would be best, yes.
Is there a timeline on when you sell and purchase, like, within 6 months, 12 months, a year?
Yeah.
How's that work?
Yeah, your whole time period start to finish is 180 days.
Oh, okay.
That's all you get. And the first 45 days, you have to basically document what it is you want to purchase. You have to identify it. And you got to identify it with particularity, and we'll cover that.
Jesse, I have a question for you.
Yes.
I had a client.
This is gonna be a great class.
Yeah.
3 questions. Honestly, it goes a lot faster for all of us.
2 years ago, they sold a rental they had in Meridian and did 1031 exchange and bought a condo on the Oregon coast.
Sure.
And they rent out through Bay Casa.
Sure. Which
They get 2
nightly
weeks.
rentals are fine. That's still for investment purposes.
They get 2 weeks out of the year where they get to go enjoy it.
Yeah. So a vacation or a second home is actually, if you look at the code, the definition of a second home is any property that you use more than 14 days out of the year for personal use and enjoyment, comma, excluding days spent on repair and maintenance.
Oh, okay.
So I love McCall, and I'm up there all the time, and I have friends that exchange I have clients that exchange into properties in McCall, and I see them skiing at Brundage every weekend. And they always say, oh, well, it's snow removal. We had to remove some snow. I will say, they also, when they're not using it, it's rented.
Yeah.
And during the week, they rent it out to the extent they can, just to help carry costs.
Sure.
So it's all about intent, right? So the moment in time when you're selling something, how is the property held? You don't get to basically have a place in the desert that you've never rented out, and then you ultimately say, I'm gonna sell it, and then you realize, oh shoot, I have this big tax liability if I do that. Now I'm gonna 1031 exchange it. You have no history of renting it out. I think to declare it as an investment property, even though you've never rented it out and you've only used it historically for personal use and enjoyment, is pretty disingenuous. And you can do that, and we will facilitate the exchange, but it's the taxpayer's risk, right? They're the ones that are telling the IRS, we held this for investment purposes, and this qualifies for a 1031 exchange. So the moment in time somebody decides to sell something, and the moment in time somebody exchanges into something else, it really should be held for investment purposes or used in a trade or business. But you can, if somebody has a house in the desert and they think, geez, we just don't use this the way we used to, we want to sell it, but we have this big gain, what do? Well, start renting it out. Show some rental activity on a tax return. Rent it out for the remainder of 2019, a few months into 2020, and then sell it next spring. And at that point in time, can you do a 1031 exchange? Yeah, I think so. I mean, now you have activity on a 2019 and some activity on a 2020 tax return showing it was held for investment purposes. But same way, when you sell it and it's now an investment property and you 1031 exchange into a replacement property, you're gonna have to hold it for investment purposes too, right? You can't buy something and then move into it. You can't use 1031 tax deferred money to buy something which you never prove your intent that it's held for investment purposes or trade or business purposes.
And do you need to hold on to that property? Because I know folks who sold properties and 1031 into a big home in the foothills, rented it out for 2 years and moved into it as a personal residence.
You can do that because they proved their intent over a 2-year period. 2 years is what I tell people, by the way. A lot of people will say a year and a day. A lot of tax professionals in the valley will say, oh yeah, as long as you rent it out for a year and a day, then you've qualified your intent, and then you can move into it and use it however you want, as a residence, as a second home. I don't disagree with a year and a day. I'm just telling you 2 years is better because the IRS has issued what's called a private letter ruling. Somebody asked this very question, and the IRS, they had held it for 2 years, and then they wanted to move into it and convert it to their residence, and the IRS said, yeah, that 2 years is fine. But they didn't say 2 years is mandatory. They didn't say a year and a day is also sufficient. All they did was answer a very specific question with a very specific answer. But based upon that answer, I can tell you 2 years, I feel pretty good about.
So after the 2-year period's over and they convert it to their primary, put the exemption in place, live in it for who knows how long, when they go to sell it down the road.
You get to take a tax-free sale under Section 1, well, they get to exclude a certain amount of gain under Section 121 of the tax code, which you guys think of as the $250,000 and $500,000 exclusion.
Okay.
But they still have recapture depreciation.
The recapture follows, that never goes away. Goes away upon death. Okay? Here's the benefit of a 1031 exchange. You defer taxes your whole life, and then you die, and all that tax liability goes away. It's forgiven. I hear people say all the time, well, we're not sure if we want to do an exchange because the kids are going to have to pay the taxes eventually anyways. No, they're not. The surviving spouse in Idaho, because we're a community property state, the surviving spouse gets a stepped-up basis. If I die today, my wife gets a stepped-up basis on all of our assets. Stock, right? Cash is cash. It's easy to value that. Real estate, all that fun stuff. Her basis becomes the market value of all those assets the year of my death. So if that becomes her basis, she could sell it a day later or a year later for market value, what we've established, and there's no gain, there's no tax liability. Okay, likewise, my wife owns it, she establishes a basis here, and then she lives hopefully for a long time, and the value of real estate goes up and up and up, and then she dies. Then we have 3 daughters. Our daughters get a stepped up basis. Everybody with me? So it's swat till you drop is kind of the joke in a 1031 exchange. You just do exchanges your whole life until you die, but your tax liability dies with you, which is a really good thing. I'll get into some other benefits of it. So I want you to just think that a 1031 exchange, I do not like the term like-kind exchange, and I hear it used all the time. Okay, oh, it's a like-kind exchange. If you say that to a client and it's a nice little old lady that's had a single family rental in the valley for a long time, and you say, have you thought about a like-kind exchange? What do you think she's gonna think that means?
Nice.
She has to buy another single family rental. Whatever I have to buy something just like it. Like-kind exchanges, it's a confusing term. It's really real estate for real estate, right? Investment property or trade or business property for any other investment or trade or business property. You can sell a single family rental and exchange into this building. This is not a single family rental. It's a commercial building, okay? So think very, very broadly on what you can exchange out of and into. Yes?
So, clients interested in this, a duplex, they're interested in doing rental properties into a duplex.
Sure.
But they would like to live in the other section of the duplex.
Sure, they can do that.
Okay,
They would just have to use non-1031 money to pay for the cost of their primary dwelling unit. You can't use 1031 money to buy a duplex and then move into half of it.
okay.
You can use 1031 money to buy a duplex, hold it for a couple of years, and then move into it. But if they want to do it immediately, they're going to have to use their own non-1031 source of funds to pay for the cost of Unit B. And then they 1031 exchange into the cost of Unit A. And we can break that out on a closing statement. We do it all the time. A good example, it's kind of, I call them a mixed use property, but let's say it's a bed and breakfast. Somebody's primary residence, and it's also a trade or business property. And typically they report on their taxes that 50 to 60% of that building, that structure, is for trade or business purposes, and that's the percentage that they depreciate. So when they go to sell it, you just have to be consistent with how you've reported. So when you go to sell it for $1 million, $500,000 to $600,000 of the sales price is going to be the trade or business property, and the remainder is your primary residence. Okay. So we have somebody new in the back. You'll want to sign in at the break.
Okay, thanks, sorry.
You bet. So it's very broad, and I mean very broad. In Idaho, if you look at the definition of real property, and I recommend all agents do this, you should all go online because it's very easy to search things online and type in Idaho Code real property and just read the definition of real property, since that's what you guys sell day in and day out. Well, in that definition, it defines a water right as an interest in real property. Okay, a lot of states out west, water is very important to us because we don't have a lot of it. So I have clients that have sold water rights for substantial sums of money, and they're able to 1031 exchange the proceeds and use it to go buy fee title ownership of other property. And it qualifies because a water right is an interest in real property, right? Another example would be a conservation easement or buying development rights. So if you think of a real pretty area, kind of the Stanley Basin, where it's the headwaters of the Salmon River, and you get a lot of ranches up there, and they always want it to be open space. And so government agencies and private, like the Nature Conservancy Group and Friends of the Sawtooth and those kind of organizations raise money, and then they take that money and they go and they buy development rights, right? They purchase conservation easements to make sure that that ranch along the Salmon River is never subdivided into a housing project. Well, the rancher that sells that conservation easement on his ranch land and receives a bunch of money for it can 1031 exchange the proceeds and use it to go buy fee title ownership to this building or more ranch land or whatever it is interest them. Okay, so that's how broad it is. It is not like kind. I don't like the term like kind at all, but people use it all the time. Okay, any questions on that? How broad it is? A lot of it's defined by state law, right? In Idaho, a water right is considered an interest in real property. Because of that, it qualifies for 1031 tax-deferred treatment. Okay, a water right in the East Coast is not considered an interest in real property. It wouldn't qualify. But other states have quotas. So if Oklahoma has something called a peanut quota, and it's the right to grow a certain amount of pounds of peanuts per acre. Their state constitution, well, it's not their constitution, it's their code, but their state code defines a quota as an interest in real property, right? The right to grow peanuts apparently is really important to people in Oklahoma. So we have clients that sell peanut quotas to other farmers, or to, sometimes they sell them back to the Department of Agriculture for money. And they take that money and they can 1031 exchange it and use it to buy more farm ground and not pay taxes on it. It's tax deferred because that peanut quota is considered an interest in real property. Okay? Now what you're gonna see primarily is somebody selling a rental and buying a rental, selling a fourplex, buying a four, I mean, it's the real generic stuff, but I'm here to tell you it's a lot bigger than that. Okay, what you can exchange out of and into is very broad. It simply cannot be initially your primary residence, your second home. And if you're a developer of real estate, you also should not be doing exchanges on property that you've developed, because that's inventory. And you don't get to defer tax on the sale of inventory, because then you're deferring tax on income. And nobody here gets to defer tax on income. If we did, it's called tax evasion, okay, which is frowned upon. Accommodator is my company, okay? Just about every large title agency or large title underwriter is going to have a 1031 exchange affiliated, a 1031 company affiliated with them, and that's a good thing. There are companies still probably throughout the country that are smaller mom and pop accommodators, right? So it'd be like if Pioneer 1031 company wasn't affiliated with Pioneer Title, it was just Jesse and Molly Hamilton. You got to be conscious of, you got to be a little leery of that, just because accommodators handle substantial sums of money all the time. And you just want to make sure that they have all the right policies and procedures in place, all the right protections in place for the clients. There have been accommodators that during the recession that failed, and investors lost their money. Their money was parked with an accommodator and they embezzled it and it's gone. And you just take a massive loss and get to start over in life. So if you're going to refer somebody to an accommodator, do some due diligence and make sure that you're referring them to a legitimate accommodator that has policies and procedures and insurance policies in place to protect the consumer. Okay, basis and adjusted basis. I have the following conversation with just about every person I talk to that's thinking about doing a 1031 exchange. They'll call up and say, yeah, I got a closing coming up and I'm gonna pocket, I always hear that, I'm gonna pocket, $150,000 and I don't wanna pay tax on it. And I go, okay, let's talk about that. You always have to back up and start with this asset that you're selling where you're pocketing 150. When people say that, they mean that's the equity they're getting out of it, right? That's their profit or their gain. And in their mind, they think, I just need to reinvest my cash. I just need to roll my profit into a new property. And that's not true. Okay, so I always stop them and back up and say, this asset that you're selling, tell me about it. How much do you have it under contract for? Oh, I'm selling it for $320,000. Okay. When did you purchase it? Oh, I bought it, 15 years ago. Okay. What did you pay for it? Oh, I think it was about $200,000. Okay. Now I know kind of what I need to know. Okay. He bought it 15 years ago for $200,000. That is his cost basis. Okay. This thing right here. I don't care what you purchase in life, a vehicle, a share of stock, a real estate asset, what you pay for it is your cost basis. Okay? Real estate's unique in that you can adjust your basis, right? Because real estate you can improve. You can make physical capital improvements to the property. So if I buy something for $200,000 15 years ago, but then I go in and I do $40,000 of remodel work, I've added money to it, right? I've adjusted my basis by $40,000. I've added to it. So now my adjusted basis would be $240,000. Real estate, we also get to depreciate improvements. Okay, once you have brick, sticks, and mortar, man-made improvements like this building, you get to depreciate that over a period of time. There's a schedule that the IRS puts you on. So now we're adjusting our basis the other way. So if somebody tells me I bought it for $200,000, I know that's their original cost basis. And then I say, have you put any work into it over the years? No, not really, just some carpet and paint, the usual stuff. and you don't need to worry about that because they would have expensed that out. So there's a difference between capitalizing something and expensing something. If it's carpet and paint, you pay for it that year, but you take the deduction that year. If you put a new roof on it, you don't get to do that. You don't get to expense out a roof. You have to depreciate it over the life of the roof, right? It's a capital improvement. Is everybody with me on this? Difference between expensing and capitalizing? So if somebody bought it for $200,000, really never put any work into it, and they've owned it for 15 years, I know what their original cost basis is of $200, and then I think, okay, they have 15 years of depreciation that they've claimed, right? So I'm going to assume that they've depreciated roughly half of what they can depreciate. So I'm going to talk about that real quick. So if I buy a $200,000 piece of property, I have to allocate value to my land. And does anybody here think you get to depreciate land? You do not. Land is a non-depreciable asset. If I'm a farmer and I own a huge farm, whatever value I allocate per acre for my farm, I never get to depreciate it. Now if I build fences and ditches and outbuildings, I can depreciate that stuff, but not the dirt itself. Okay? So when I buy a $200,000 home 15 years ago, let's assume that I allocated $40,000 towards the dirt, and that means I had a $160,000 structure, right? That's the improvement, the rental property. Now I have this $160,000 bucket, and the IRS tells me, Jesse, because it's a single family rental, you get to depreciate that $160,000 over the next 27.5 years. That's the schedule. It's called a depreciation schedule. If it's a commercial building like this, it's 39 years. It's a much longer period of time. So I have $160,000 over 27.5 years, and I can't do the math in my head. We're just going to do 50-50. Let's assume that over 15 years, I have depreciated half of that. So I've taken $80,000 of my 160, right? Half of it, and I've written it off. So over the last 15 years, I have sheltered $80,000 of income with my depreciation allowance. Everybody get the benefit of depreciation? Every year the IRS tells me, Jesse, I can do the math, I guess. But if I take, what did they say, 80,000? Okay, my allowance every year is $5,300. So every year the IRS says, Jesse, you have a $5,300 depreciation allowance. Now, I have this rental property and it generates income. We hope it does. So let's say that after I pay all my expenses, after I pay my property manager and my taxes and insurance and everything else that I can deduct, I end up with $10,000 of net operating income. Okay? That is taxable income. If I did not have a depreciation allowance, I would have to report and pay ordinary income tax on $10,000. Agreed? However, I have a depreciation allowance. So the IRS says, Jesse, you get to depreciate or write off or protect or shelter, however you want to think about it. Out of this $10,000 amount, $5,300 of it you can shelter. That's your depreciation allowance. Your depreciation allowance offsets income. So I end up with $10,000 and I can spend it how I please, but I only have to pay income tax on the remaining $4,700 balance, right? Huge benefit. That's why people own real estate, is the tax write-offs. The depreciation allowance is a big part of it. Appreciation and value and all that's certainly a part of it, but it's a good income shelter. So I've been doing this over 15 years. So over 15 years, I've taken this $5,300 allowance, this depreciation allowance, to shelter $5,300 of income, but now I'm selling it. So if I don't do an exchange, I have to recapture. It's the word this gentleman used. You have to pay back. You have to recapture 25% of what you've depreciated, right? And I had depreciated $80,000. That's what I've accumulated over the years. So I have this liability bucket that's depreciation recapture at 25%. And then I bought it for $200 and it's worth $320. right? That's my capital gain. That's how much it's gone up in value on its own. So I have a $120,000 capital gain. I can promise you, most of your clients that sell investment or trade or business property have not only a capital gain liability, but also a depreciation recapture liability. So there's usually two taxes at play. Not always, but usually. So in this example now, I had this conversation with the gentleman and I've learned more, and I said, okay, your basis was 200, but you've depreciated 80 out of it, so your adjusted basis is now 120. Okay? Your sales price is 320. You have a $200,000 tax liability. 80 of it is depreciation recapture, 120 of it is capital gain. Everybody with me? If not, raise your hand. I mean, these aren't easy concepts.
So their recapture is 25%, you said?
Just a federal rate at 25%. You don't pay anything to the state on recapture.
And capital gains is percentage-wise?
For most people, 15% to the Fed, a little over 3% to the state of Idaho.
Okay.
If you're wealthy, like you have adjusted gross income of $1 million or more that year, it's 20% to the Fed, 3% to a little over 3% to the state of Idaho. I tell people 20%. In Idaho, if it's Idaho property and an Idaho taxpayer, 20% on the capital gain is a good number. So we can quantify this now. Now I tell these clients, well, you know, your CPA can tell you to the penny what your tax liability is going to be, because I don't know anything with your tax picture other than this isolated instance we're talking about. But you have a $120,000 gain with a 20% liability on it, that's $24,000. You have an $80,000 recapture liability at 25%, that's $20,000. You have a $44,000 tax bill if you sell this property and don't do an exchange. Right? And I like to go through this with all my clients just to make sure it's worth their while. Because a lot of people think, oh, I made $40,000 on this property, because you know they bought it last year, so they have very little depreciation. They haven't depreciated much out of it. But they made $40,000. Well, you come to find out, you know, they bought it for $200. You're going to list it for $240, which is good, right? That's a profit. That's awesome. But by the time you sell it for $240 and then pay your closing costs, right? Realtor commissions, title fees, escrow fees, recording fees, any other professional fees that you have, you know, an accountant or an attorney to review stuff, you get to deduct that. Right? And that it comes out of that $240,000 sales price. So on a $240,000 sale with roughly 7% towards closing costs, that's, you know, let's say $15,000. So $240 now becomes $225. Agreed? Okay, I'm here to tell you, when you sell real estate, you get to deduct your closing costs. From here on out, I'm going to use gross numbers, right? You sell for $300, right? The numbers I just gave you, he bought it for $200, he sold it for $320. I know that there's going to be $20,000 of closing costs that they get to deduct. So really, he bought it for $200, and then after closing costs, he's going to end up with $300. So he really only has a $100,000 gain. Just understand that, but I can't. The math gets really, really hard if I try to deduct out closing costs all the time. So $240 really becomes $225, and our original purchase price is $200. So we have a $25,000 taxable gain. Agreed? It's great. Making money. If you're paying tax, you're making money. It means you're doing something right. But that's a $5,000 tax bill. Is it worth it to spend, you know, a few $100s on an accommodator and have to purchase replacement property within this 180-day time frame just to not stroke a check for $5,000? I would argue no. It's just not worth it to me. I have clients that will do anything to not pay tax. I mean, there's people throughout this country that would rather, they would spend $750 on my company and have to go purchase replacement property, which costs money, by the way. I love real estate, but I'm here to tell you, it costs money to buy and sell real estate. So they're purchasing property, which has an expense to it, just to not pay $5,000 in tax. To me, that doesn't make sense, but to some people it does. Now, And my other example of $44,000, does that make sense? It starts making a lot of sense. And the question really is, in a perfect world, when you sold this old property, do you want to buy more real estate? Do you want to buy more replacement property? And if the answer is, oh yeah, I love it, then why would you not do an exchange? If somebody says, we're just not sure, we'd like to pay off the debt, not have to worry about new debt, or we'd like to invest in our kid's business, or we just want to have cash, okay, then it's probably not the right tool for that client. That's all a 1031 exchange is a tool. And it's only the right tool when somebody decides it is. Yes?
When you're talking about original purchase price, establishing a basis,
Yeah, that's your cost basis.
does inheriting work the same way? So instead of you buying,
You get a stepped up basis on inheritance, yeah. So basically your basis through inheritance becomes the value of the asset the year of the decedent's death. So when somebody dies, their estate still has to file a tax return, and there's a schedule of assets that you fill out, and you put down the fair market value of everything. Whatever that fair market value is listed as in the estate's tax return becomes the devisee's, whoever is bequeathed or inherits the property, their cost basis becomes whatever was told to the IRS. Does that make sense? Okay. And that's called a step up in basis, because the person that died had a low basis, their basis was this low, the value was way up here, but they died, step up in basis, and that's what the heirs get. Yes?
It doesn't necessarily have to be upon death, like you can gift that as well, correct?
You can gift within your lifetime, but you have to then report it as a gift, and it reduces your estate tax exemption level. So we can talk about that. So there's something called the estate tax. Idaho does not have a state estate tax. We don't have it, which is great. The federal estate tax basically says, if you die and your assets, all of your assets are worth more than $11.4 million, that's where we're at today. From 11.4 million and under, there's an exemption. There is no estate tax. If your estate is worth more than that, every dollar above 11.4 million is taxed at roughly 44%. It's a really hefty tax. That's why people don't like it. So what this gentleman asked is, can you do something within your lifetime? Yes, my parents could go ahead and gift me a rental property, right? Just quitclaim deed it to me. But for me to get a step up in basis, they then have to report, dear IRS, this property is valued at $500,000, and we are giving it to our son within our lifetime. So our estate tax exemption now becomes $10.9 million. You're just using your $11.4 million exemption, you're using $500,000 of it within your lifetime. Yeah.
And then the property gains or the gains, capital gains go to.
They go away. There's no gain. So when I get the gift, my basis is $500,000, right?
Yeah.
And then, so that's my cost basis, and so I would only have a capital gains tax as that property continues to escalate in value. Yes?
So just see the difference between the gift and the grant.
A gift and a grant. Grant deed, that's California calls it grant deeds. Gift deeds, it just depends. I mean, if you just quitclaim deed, gift deed, grant deed your children something, but you don't report it as a gift to the IRS, then your children are just receiving your cost basis. That's all that's happening, right? You're just quitclaim deeding an asset. It happens all the time in Idaho, right? A farmer who was quitclaim deeded the property from his grandpappy, and then he quitclaim deeds it to his son. I have had clients that when they go to sell the farm, they basically had to go back and research and determine what the cost basis was in like the 1920s, because the asset was always just deeded during somebody's lifetime. It never went through the probate process. These farmers just give the farm to the kids, and they don't report it to the IRS as a gift. So their basis is whatever great-great-grandpappy's basis was in the 1920s, which means when they go to sell it, they have a massive tax liability.
So we just did the quick claim, actually it was a grant deed, And so, Katie sent the grant deed to Joe's mom and dad with it, and it was $10.
Yeah.
So they did the grant deed with a $10.
Yeah, it's just, that's because deeds require consideration. You could have just said for love and consideration,
Okay,
but people usually use $1 or $10.
okay.
But it doesn't matter, your parents are still gonna have to report, if this is a gift that they want to make during their lifetime and reduce their estate tax exemption, they're gonna have to report it as such. They need to report it on their tax return, and then that way you get the step up in basis of that asset.
Jesse, quick question.
Yes.
On the gift deed, does that also wipe out the recapture depreciation?
It does. Same difference as if I died. We're just making it look like we died, but we're still alive.
Dying on paper for
Yeah.
investment.
So any tax liability associated with the former owner simply just goes away. But they just reduced their estate tax exemption by $500,000. Here's the deal, the estate tax exemption is at a very high level, right? $11.4 million is a massive amount. That excludes 99.2% of the country, probably, if I had to guess, somewhere thereabouts. Well, a long time ago, well, not even that long ago, in 2003, it was $650,000. It was a lot lower. So there were a lot of farmers that they never consider themselves wealthy because they think of wealth in terms of income, but the land value was increasing. I mean, you take a farmer that owned property in Eagle, and in 2004 they die. If you appraise the property for highest and best use, which is for development property, that farm's worth a lot of money, right? If it's an 800-acre farm, it would be worth a staggering, well above $650,000. So that's why over time, we've had an increase. And then Trump, to his credit, in 2017, under his Tax Cuts and Jobs Act, he took the exemption, which was 5.6 million. It had gradually increased up to and he just doubled it. He said it's now 11.2 million in 2018, and then they put a little consumer price escalator on it every year. So this year it's 11.4 million. And next year it's going to be 11.6 and change, and then it's going to be 11.9. It's going to continue on. It sunsets in 2024, and we'll see what happens then. Okay. So the estate tax has become it's become less of an issue. I dealt with it all the time in 2002, 3, 4, and 5 early on. And then when they finally really bumped it up to 5.6 million, and that was Bush, George W. That made it easier. And then when Trump doubled it, there's still people that have assets worth or estates worth more than that, but they're pretty wealthy, sophisticated people, and they've done estate planning, so they got it taken care of through trusts and generation skipping entities and stuff. Okay, so any questions on basis and adjusted basis? What'd you pay for it? What amount of improvements have you put into it? How much have you depreciated out of it, right? What'd you pay for it? Plus what have you put into it, minus what you have depreciated out of it. That gets us to our adjusted basis. The difference between your adjusted basis and your sales price is your tax liability. Okay? A lot of people think, I just have to exchange my gain. Jesse, I bought it for $200,000, I'm selling it for $320,000. I just have to exchange the $120,000 difference. Not at all the case. Okay? Because we have basis in the replacement property. This is an important concept to understand. In an exchange, the IRS wants you to be in the same tax position you were in before, just in a different property. So if I sell for $320,000, I pocketed the first $200,000 because that was my original investment, and I only reinvest my gain or my profit, you're in a much better position. Much better position. So it's not how it works. Your basis in the old property simply shifts over to the replacement property. So in this example, I got to remember the depreciation we added in. So what I say that adjusted basis was $120,000, right? Bought it for $200,000, depreciated $80,000 out of it, selling it for $320,000. So our adjusted basis is $120,000. That basis of $120,000, the first $120,000 that we reinvest, There is zero tax benefit to that. That's just basis. All we're doing is just moving our basis from property A to property B. Every dollar above $120,000 that we reinvest, we're deferring tax on, right? Up to $320,000. Everybody with me? It's important to understand that. People always, if you ever hear somebody say, yeah, I'm gonna pocket or I'm gonna net, in their mind, they think I just have to exchange my cash or my profit. And then I give them the bad news. Well, I wish that were the case. Everybody would do an exchange, but that's not really the case. You have to roll your original investment plus your gain.
So the adjusted basis, that's the.
Yeah.
That's,
Yeah, and it's, yes. Yeah, your original investment, when I say that, it's your cost basis. And then there's fluctuation in there because of depreciation, but it's basically your original investment plus your gain. So that's why you always hear people say you need to buy a property of equal or greater value. That's where it comes from. If you want to pay zero tax, then you need to purchase a property of equal or greater value as what you sold. So if you sold for $320,000 and at closing you pay $20,000 to the realtor and the title company, that leaves you with $300,000. If you go buy a $300,000 replacement property, you've deferred all your tax liability. Anything under that, you're going to pay tax on it. Everybody with me?
your deferred liability goes away after 2 years if you change it, it doesn't ever go, even if you change it over to the primary.
If you convert it to your primary residence, your depreciation recapture never goes away. That's always a liability to worry about. And you get to, moving forward, there is a massive benefit to excluding most of the gain. And I'll get to that. It's a formula. It's still a huge benefit and people should do it if they can. Okay, boot, the next item down is boot. Boot is simply what you don't reinvest. So there's cash boot and there's mortgage boot. So let's talk about that. So I have this asset that we're selling for $320,000 and our adjusted basis is $120,000. Let's assume that it's free and clear, right? No debt against it. So when I sell it, after I pay my closing costs, $300,000 goes into the exchange and we go reinvest $260,000 of it to buy a replacement property, but that's all we spend. Okay, at the conclusion of the exchange, there's $40,000 left over that is not our money. So I'm going to give it back to my taxpayer. And when I do and they touch it, they have to recognize the gain, right? They have to pay tax on it. That's cash boot. It's just money, it's cash money that was not reinvested through the exchange. It would be no different than if my client at closing just said, listen, Jesse, we're selling this for $320,000. I know what I'm purchasing and it's only worth $260,000, so I'm just going to pocket $40,000 from the escrow officer at the closing at the time of the sale. Okay, that's fine too. That's cash boot. You're just going to pay it. You're going to recognize it sooner. Okay, there's also something called mortgage boot. So now let's assume, like most people, that this rental property has a $100,000 mortgage against it. Okay, so when we sell it for $320,000, we pay off the closing costs. We have $300,000 left over, and then $100,000 of it goes to the bank. You got to pay off the bank to clear title for the incoming purchaser, right? So that means there's $200,000 of cash that comes into the exchange. And we turn around and we use that and apply it towards the purchase of a $260,000 replacement property. We get a mortgage for the $60,000 difference, and we're done, right? We buy our replacement property, we've reinvested all of our cash proceeds, so there's no cash boot, but there is debt relief, right? When I say mortgage boot, think of it as debt relief. What was our mortgage amount on the old property? $100,000. What's our mortgage amount on the new property? We trade it down in value, right? So it's taxed the same. It's the IRS doesn't care. It's the same dollar, whether it's cash or whether it's debt. It doesn't matter. You needed to reinvest $300. You only reinvested $260. So you're going to pay tax. It's just a matter of is it cash boot or is it mortgage boot? Either way, it's the same. It's taxed exactly the same. So that's what boot is. Any questions on that? I will also add, if we sell a property for $300,000, but we buy something worth significantly more than that, what if we step up our basis? right? What if I sell for $320 and I pay my closing costs and I have $300,000 to reinvest, and I turn around and I buy something that's worth $300 plus another $2, a $500,000 replacement property, right? I'm adding money to my basis, agreed? I'm bringing new, it's either money that I have or it's money that I'm borrowing, but either way, it doesn't matter. I get to step up my basis by $200,000. So if my adjusted basis in the old property was 120, and I buy a replacement property that's worth $200,000 more than I needed to reinvest, my adjusted basis in the new property is now $320,000, right? My old basis plus the new money. It's just that simple. And then you put that on a brand new depreciation schedule. And that happens, that scenario happens all the time, because once somebody has an asset that's fully depreciated and they no longer get that income shelter, they sell it, they typically buy something that's worth significantly more money so they have more basis that they can begin depreciating all over again, right? Okay. I can tell you, Ron Van Acker just sold all of his assets in the valley. You guys aware of that? Okay, there's a company called Adler Realty Investments that came in with private equity money, and they bought all of Ron Van Acker's assets. I mean, his whole portfolio, all his land, all his buildings, everything. They bought everything except his construction company for a big pile of money. And Ron didn't do 1031. He's been using us for exchanges for a long time. He just wanted to cash out. He didn't do any 1031 exchanges, and he's owned the buildings for 40 years. I mean, he's fully depreciated on them. So the check he got at closing, he had a massive tax liability on a lot of it, just because he has capital gain, and he also has a lot of depreciation recapture. But that's, you know, he just got to a point in his life, I'm sure. I haven't talked to him about it, but I'm sure he just kind of wanted to liquidate and have cash, and it makes it a lot easier to inherit money, cash, than it does to inherit a bunch of properties that you got to actively manage and maintain and deal with. So anyways, that was a big deal. I don't know what the final, I have an idea what the final price tag is, but.
So isn't that like pushing close to 50% with the combined recapture and capital gains?
Well, no, they're not, they're mutually exclusive. So his recapture liability is going to be 25%, and then at Ron's income level, he's going to be at 20% for capital gains, plus the state of Idaho.
23.
And there's
3%.
23, yeah, so it's on average, but he has basis in that. So let's say hypothetically the number was 200 million. And let's say he has a basis of 80 million, they can't tax him on that.
Okay.
He's got $120 million of either capital gain or depreciation recapture, and he would have paid 25% on that amount.
Correct.
Yeah, so not 50%. They don't double tax you.
Jesse, what's the tax commitment on the food? So if we have a client that's gonna withhold $40,000 in cash food.
Yep.
What's their tax commitment on that $40,000?
It's your
Well, it's not income.
Well,
It's not. It's either you pay depreciation recapture to the federal government first, right? So that if there is depreciation recapture, you're going to pay that first at 25%. Plus, you have to pay the state of Idaho their capital gains tax at 3%. So it could be 28%. If there is no depreciation recapture, you're just going to pay capital gains at 15%, plus the state of Idaho at 3%. For 20, an 18 point something percent interest.
Okay.
So it just kind of depends on somebody's tax picture.
Yeah. And oftentimes clients come to me with 1031s, or my first recommendation is you should work with your accountant. And make sure it's worth it.
Always. You guys
have
should all say that
accountants?
all the time.
Do you have accountants you can recommend if they don't have one?
Yeah.
Okay.
I mean, I know lots of accountants. And it's, it's like anything. A brain surgeon doesn't know anything about feet, right? I'm not going to go to a brain surgeon for.
they do.
All doctors think they know everything.
Well, they call it practice.
Yeah, and so I don't expect a CPA. A lot of CPAs just don't deal with a lot of 1031 exchanges. A lot of them just do tax preparation, and it's just the average bunny, run-of-the-mill, easy stuff. So there are some that do a lot of 1031 exchanges. There are some firms that do a lot of training and education to their staff, and so they're more attuned to it. So if you have somebody that honestly just says, well, I've never reported on a 1031 exchange, that's not a bad thing. I mean, it's a form, it's not hard to do.
For an entry level type mom and pop investor that they're gonna sell their single family rental, buy a duplex, but need to consult with an accountant, they don't have one.
Yep.
What do you think it typically costs them to consult with an accountant to figure out what their tax amendment would be?
The first consultation should be free.
Okay.
That's just them interviewing somebody, but it's not gonna be, I'm gonna report this 1031 exchange for you. It's more, I'm gonna do your tax reporting for you for everything.
Gotcha.
You don't tend to parcel it out. You might have different entities, like a business might use one CPA and the individual might use another.
Yeah.
It depends. I mean, I know what I pay for my CPA to prepare my return every year.
Yeah, and you know, I'm a tax accountant myself, but I do have some mom and pop investors that do their own taxes.
Sure.
That are just real hesitant to go meet with a referral.
Which means they have to do their own research and make their own decisions on whether they want to do an exchange, whether it's worth it, how to report it. It's their risk.
Yeah.
I have a lot of clients too that say, oh, I file my own return, and I always think, okay. I mean, I'm perfectly capable, I have an emphasis in tax at law school. I can prepare my own tax return, I don't do it. Because I want the IRS, I want to keep it arm's length. I want the IRS to know that I'm a good little taxpayer, so they have no reason to audit me.
Good question. So selling an investment property in California and coming to Idaho, building brand new into an
Building,
a residential.
you're building a new one?
Yes, custom built home, either into.
Is it gonna be finished within 180
Yes,
days?
I get that, the trick with the 180 days.
Yeah, when people talk about
Or
new
you can do
construction.
dual closing and just do the value if you don't reach that 180.
Yeah, if you're selling in California and you need to reinvest $200,000 to satisfy the exchange, but the replacement property here is gonna cost, not be worth, but gonna cost $400,000. You only need $200,000 in value to
Correct.
exist before you take title to it.
Correct.
And then you just
But
take
you're
title.
looking at two closings.
Yeah, you take title and then continue to finish construction, and that just adds to your cost basis.
Correct. But could you do an Airbnb or a rental property, like a?
Yeah,
Well, I
that's
get
good.
it.
A nightly rental qualifies. Airbnb, Vacasa, VRBO, all those are held for investment purposes.
Okay.
Yeah, because I mean, you're gonna report a lot of rental activity.
And does that time frame? I guess your 2 years doesn't start until the close of the sale of the 1031 exchange, correct?
Yeah, the close of your purchase of replacement property, that's when your time frame starts to run. And then how you hold it from that point forward will determine what your intent was. Okay, buyer, that's easy. Deferral, we're putting off to a later date, okay? If that later date is your death, you win, you gotta die to get there. Okay, that's all tax deferred exchange. I have clients that don't wanna pay tax today, but then they tell me, yeah, I'm gonna 1031 exchange into this other property and we're gonna fix it up and then I'm gonna sell it. And I go, okay, what are you gonna do then? Well, I'll just pay the taxes. Well, then why in the hell are you gonna do an exchange today? Just pay your taxes today, because you know what they are. You know exactly what your tax rate is. Capital gains tax is very low, okay? It's as low as it's ever been. 15%, very low. Under Reagan, who was a Republican, it was 28% capital gain rate. It's not gonna go down. I'm here to tell you, nobody's taxes are gonna go down moving forward. Okay, so if somebody is thinking of, I'm just gonna do an exchange now, but then I'm gonna exchange into something else, I'm gonna hold it for a year and then sell it, and I won't do an exchange, I always question, why? That you're just gonna end up paying your taxes a year later.
And it could be more.
It could be more, you don't know, I mean, just take the certainty of today. So,
Yeah, I think that people confuse capital gains tax with income tax.
They do.
They think when they retire, they have no, their income is lower.
I hear that all the time, is,
Yeah.
well, I'm gonna retire and my income, my marginal tax rate goes down, and I go, that's great. Your capital gains rate is exactly the same. Doesn't do any good. Now, if you make under $34,000 a year, you have 0% capital gains tax. Here's the funny thing. If you sell an asset and you don't do an exchange and you recognize the gain, that whatever that gain is, adds to your adjusted gross income. So if you were you could be at the poverty level and make $18,000 a year, but then you sell an asset and you recognize $100,000 of capital gain, it's still gonna put you right back up into the 15% tax bracket. So you're not getting ahead. I mean, that's what I tell people is retirement's not gonna help you with anything other than your income tax rate, not capital gain.
And if you have enough rentals when you retire, it doesn't help you with your income tax.
No, hopefully you got a lot of rentals and you just have passive income and you have a wonderful retirement, but you're gonna pay tax on all that
You pay
rental
tax on
income.
that, yeah, so the tax doesn't go away.
Never. Death and taxes. It's two things in life that are certain. Okay? Depreciation recapture we've talked about. Whatever you have depreciated over time, if you ever sell an asset and don't do an exchange, you have to recapture it or pay back 25 cents on the dollar. Still it's a great thing. On my example of $80,000 of accumulated depreciation, we have sheltered $80,000 of income over the last 15 years. And now I only have to pay back 25 cents on the dollar. That's still a positive. That's a good thing. It's not like you have to pay back 100% of it. Direct deeding. In an exchange, usually the property is deeded directly from the seller, from the taxpayer. So Jesse is starting an exchange. I'm gonna deed, what's your name?
Christian.
Christian. He's my buyer. So as the taxpayer, I'm selling a property to Christian and I'm deeding it directly. Jesse and Molly Hamilton, hereby grant, bargain, sell, and convey unto Christian the following described real property, blah, 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 blah. Okay? Likewise, that now activates the exchange, and so Jesse and Molly now have an active 1031, and we turn around and we go to buy a replacement property that Christian is selling. Okay, we enter into the purchase and sale agreement. We use our 1031 money towards the purchase. Christian is going to deed the property directly to Jesse and Molly. Okay, it's direct deeding. When the 1031 section of the code came about in 1990, the IRS actually they looked at it and said, well, the only way this is going to work is if Jesse and Molly can't touch the money. So the only way that's going to happen is if they don't own the property. So Jesse and Molly are going to have to quitclaim deed or convey their interest in the property to an accommodator. The accommodator then sells the property to Christian. The accommodator then holds on to the money. The accommodator turns around and purchases the replacement property. Christian deeds it to the accommodator. And then ultimately the accommodator deeds it back to Jesse and Molly. Anybody see problems with that? Like so many problems.
Yeah.
Idaho doesn't have a transfer tax or an excise tax, but a lot of states do. And if you're deeding property around like that for value all the time, you're gonna pay a lot in your excise tax or in your transfer tax. You're also voiding title insurance policies, right? You guys might not see value in title insurance, but I'm here to tell you, you talk to somebody that's ever had a title claim, and there's a lot of value in a title insurance. It's like any insurance. You don't like paying for it until you need it. And then it's nice to have. So if I deed the property to an accommodator, I just voided my owner's policy. What if I had financing against the property and my bank says, hey, you just transferred title to the property and didn't notify us, that's due on sales, you're in default. I mean, I can give you lots of hypothetical issues. So your association, the National Association of Realtors came in and vehemently argued that that is the dumbest thing we've ever heard. We're just going to allow people to deed directly from the seller to the buyer and from the seller to the buyer on the other side. All the accommodator needs to do is take an assignment of the money. So that's all my industry does. At closing, we take an assignment of Christian's rights in the purchase and sale agreement. So as the seller, what is he entitled to at closing? What does a seller get at closing? Money. So all the accommodator is doing by taking an assignment of the purchase and sale agreement, the seller's rights in the purchase and sale agreement, is taking an assignment of the right to receive proceeds. That's all we do. We take the money, we touch the money because you can't. If you touch it, you gotta pay tax on it. And likewise, we hold on to that money and you instruct us how to deploy it. You go make an offer, work up terms and conditions. We take an assignment of your right as the buyer, but now the deed is directly to you. All we're doing is applying the funds towards the purchase of that property. Okay, so that's called direct deeding, and that's a good thing. The exchange period is 180 calendar days. It does not matter if the 180th day falls on a weekend or holiday. The IRS does not care. Okay, you have to complete your exchange within 180 calendar days. So if your client's 180th day falls on a Saturday, Sunday, or holiday, what does that mean to you? Close it the most recent business day where the county is open to record and the banks are open to fund. A title company, I will send an escrow officer in to sign a file on a weekend. It's not going to fund and record until the county's open and the bank funds it. So it's just know your time frames. People always say, can I get an extension? You can ask for one, you will never get it. Never, ever, ever, not in the state of Idaho. Okay, the only properties literally that I'm aware of that ever get extensions are properties that are within a presidential disaster relief area. Okay, Hurricane Katrina was a good example. Anytime there's a massive hurricane, Idaho doesn't have natural disasters. I mean, we have fires and they're in the interior and they're not around property that people are buying and selling, so it doesn't really affect us. If we ever had a presidential disaster relief area, then any properties within that area would be given extensions because it's very difficult to buy something if it's underwater or if it's burned up. It's even harder to sell something if that happened. Okay? The exchanger, that's my client. You call them customers and clients. I call them exchangers and taxpayers. We've talked about gain. Okay? The one thing I'll clarify is there's two types of gain, of capital gain. There's long-term and there's short-term. If you own property for more than 1 year, okay, the moment you own it for the 366th day, right? Midnight clicks over and it's the 366th day, you qualify for long-term capital gain, which is a good thing. Okay, it's that 15% tax rate we're talking about. If you own property for less than a year, it's short-term gain and it is taxed the same as ordinary income. That is a bad thing. Okay, the highest federal tax rate right now is 37%. The highest Idaho state income tax rate is 7.8%. You add those two together and that's 44.8. That's your if you're a really high earner, right? If you make a lot of money, you're gonna pay 44.8% on your capital gain because it's short term, because you didn't hold it for long enough. Here's an example. Let's say that I've optioned a property in Eagle, but I optioned it a long time ago for not much money per acre. And then we've had this massive run up in land pricing, and so now I think, well, you know, my option is worth $2 million. I mean, I have the right to buy this property for $1 million, but it's really worth $3 million to a developer, somebody else that wants to purchase this and do something with it. So I could do a simultaneous closing where I basically, I take title briefly, I kind of flip it, right? I sell it to somebody for $3 million. Their money, I use $1 million of it to pay off my option purchase price, and then I pocket $2 million. But I held title for 7 seconds, so it's short-term gain. I'm going to pay 44.8% on that money. That's a lot of money. I mean, I made a lot too, but a lot of it goes away in taxes. If I were able to basically say, hey buyer, why don't you give me $1 million of non-refundable earnest money so I can use it to purchase the property today, take title to it, hold it for a year. I will simultaneously give you a right to purchase the property a year and a day from now, right? And that's when you'll pay me my $2 million difference. I'll even discount my price by $150,000 for, you know, the use of your funds over that period of time. But regardless, I buy it, I take title, I hold title for a year and a day, and then I sell it for $3 million. My $2 million in profit is now taxed at 20%. It's a massive difference.
Can they take possession of it then as well?
Sure, I could buy it, but I could literally lease it to the developer to let them get going on doing all their preliminary plat work, all the annexation, whatever they needed to do. So it's, if you can structure it to where you can actually hold title for a year and a day, you will definitely make more money. because you will pay less in taxes. And every time, whatever you don't pay in taxes, simply, you maintain that as your net worth. Whatever you pay in taxes decreases your net worth. Okay? All right. Identification period is 45 days. You have 45 calendar days to identify. If it falls on a Sunday, that's fine. Just fill out the form, sign it, date it, scan it, email it to us by midnight of the 45th day. Can you get an extension on it? No. Nope. There are no extensions on the 45 day. Now, you can change your mind as much as you want within that 45-day period. It happens all the time. I have clients, especially during the recession, that were buying stuff in trustee sales. So they would identify stuff and they were constantly having to re-identify just because some of the sales would get postponed. Some of the sales, they weren't the successful bidder. They didn't get it. So they changed their mind all the time. That's fine. But whatever we have on our file, midnight of the 45th day, that's it. You're stuck with it. If you find your dream property on day 60, that's great. Go ahead and buy it. But it's not going to be with 1031 money. Your exchange is going to cancel and fail. You're going to have to recognize your tax liability. But if you get your dream property, there's worse things in life, right? Okay. Yes?
Can you identify your property prior to your selling property before it's under contract?
Yeah, but you don't need to. I mean, the identification is a form I just need by midnight of the 45th day. So you can, yes, you can go out and physically select and know what you want. You can even put it under contract.
That's what I'm asking.
You just want to delay your closing. You don't want to obligate yourself to purchase until you have successfully closed, because most people need the equity coming out of the first property to pay for the second property. But you can have it under contract. The IRS does not care about contract execution dates. They care about closing dates, right? When is consideration paid back and forth? That's what triggers everything to the IRS. I recommend, if you can, the best job a realtor can do is to list a property for somebody, find the right buyer, know that the buyer is going to perform, use the due diligence period leading up to that sale to go find suitable replacement property, get it under contract. Then you close on the one, and days later, same day if you want, we immediately purchase the replacement property and the exchange is over. And that, it makes it so easy for the taxpayer. The hardest part of an exchange, and this, we're seeing a lot of it right now, is, hey Jesse, you know, the Smiths are in closing, they just decided to do a 1031 exchange. Can you get in place by this afternoon? Well, like, yeah, send the Smiths away, have them come back in the afternoon to sign. In the meantime, we'll work up the file and get everything prepared in place. The Smiths literally now have 45 days to run around and with their head cut off and try to find something. That's hard.
And you gotta make sure the Smiths don't get the money first.
Yeah.
That's why they called us, right? So at closing, we get it, they don't. But they just decided today to do an exchange and their clock starts to run tomorrow.
Yeah.
So now they have to think, oh God, what are we gonna do?
Yeah.
Versus when they put their property under contract 45 days ago,
Yeah.
and they decided, because their realtor said, have you considered an exchange? And then they educate themselves on it and they decide, yeah, that's what we want to do. They can use their sale escrow period to figure out, what do we want to do, right? What property do we want? What exists out there? What's a good buy?
Yeah, for example, we listed a little single family home in Meridian. We knew it was gonna be a hot button for an investor, who's doing a 1031 into a duplex. And we negotiated with that buyer a close date all the way out to the end of August.
Yeah, delay closing.
Saying, hey, give us all the way to the end of August. If we find another property in that time
Then we'll
period,
speed up closing.
yeah, we'll speed it up.
Yeah, sellers have a lot. I mean, the market, I'm curious to see what the market does next year. This year, it's still kind of a seller's market, so you can dictate those terms.
Yeah.
You can, and that's typically what the large land transactions, if you're a farmer and you're getting out of the business of farming, right? You're selling a $10 million farm. What you don't want to do is close today and then have $10 million to spend really fast.
Yeah.
Yeah.
So they don't. The farmers that are well represented basically say, listen, I'm going to give you the right to buy this, but I have the right to delay closing until the end of August or into next year. But as I find replacement properties and get them under contract, then I can notify you and you have 10 days to perform and we close really fast. I've even seen buyers put up 100% of the purchase price in escrow, and it's just sitting there waiting until the seller says, I'm ready to go. I found what I wanted, and then it closes, and then we have the money, but they know where it's going. So the hard part of an exchange is the timing aspect. It's always the timing.
Do we have to identify it in the purchase and sell agreement on both sides that buyer agrees at no cost to the seller?
I think it's smart. You don't, do you have to? No. If your seller signs a contract and there's no mention of a 1031 exchange, but the contract is checked assignable, now the RE21 forms, you guys have the little box, this is or is not assignable. Contract does have to be assignable. Because how can the accommodator take an assignment of it if it's not assignable?
So you don't.
But I like the box to be checked as assignable, and under other remarks or comments, I also like it to be seller reserves the right to complete a 1031 exchange at no additional cost, expense, or liability to the buyer.
So if another agent in California is actually going to sell that property, he has to make sure that that is.
I don't know
assignable.
California law as well, but you should just have some general 1031 cooperation language in place. It doesn't have to be real specific. I've heard agents tell me, Jesse, I don't want to reference anything when I'm representing a 1031 buyer. I don't want to put anything in the contract because it gives the seller leverage. They know that we're on a time crunch. Okay, I mean, I can, if you don't like providing people, I get it. At the same time, if I'm a seller and somebody comes to me with a strong offer and I know that there's a 1031 buyer with real money behind that I can verify, I can call the accommodator, get permission to call the accommodator and verify funds, I actually prefer that offer.
Yeah, I've lost offers because the competing offer was in 1031 and it was,
All cash.
yeah, there's money to be lost if they backed out.
So I don't see it as a downside. I don't think it gives the other side any leverage. The exchange has zero impact on the other party, by the way. Doesn't affect them at all, literally at all. Yes?
Do you guys truly hold the exchange, or is it like, you just have a pool or a warehouse or whatnot, and if so much money goes into this exchange, just know that within 180 days you'll be getting that money back, or do you truly keep?
We have all the, we have $112 million on deposit as of last night, but it's segregated interest-bearing accounts. So it's not a pool of money, we do not commingle money. That's a horrible, horrible idea for a lot of legal reasons. So every time we have 258 active exchange files right now, totaling $112 million. So it's not pooled. I mean, we tend to use the same banking institutions to deposit the funds with, but they're separate accounts.
Yeah, I should know if it was like a type of like an IOU type deal where it's like, oh yeah, hey, when you're ready, within the guidelines of 180 days, we'll get back to you or whatever, you know what I mean?
You know, it's our industry is not real regulated, and there are exchange companies that probably take people's cash and invest it in really sketchy stuff.
It's gonna be like that's a depository, right?
Huh?
Like a depository institution? Like that's what it is.
Well, I can give you some nightmare examples. We use Bank of the West. I know a Central Credit Union I've used for 18 years. They're a great, and they give us a great rate because we pay interest to our 1031 clients. So while their money is on deposit, it's earning interest. It's not a sexy amount of interest, right? Interest rates are pretty low. It's about 2% right now. Actually, ICC is at 2.25.
But it's still a nice treat. I did one 3 years ago personally, and I didn't know that I'd get interest back.
Yeah, you get it.
It was through your company.
Yeah, and you get a check for, you know, a few hundred to several $1,000s at the conclusion of the exchange, and you just think, oh, great. But there are companies, especially during the recession, that were taking people's money, and there is no federal oversight, right? There's no federal agency that regulates, none. And it's, so in theory, I could take that money and invest it however I want. And that's where you don't want to use a small mom and pop kind of accommodator because you don't know what they're gonna do with the money. So there were Land America Exchange, you guys remember TransNation Land America? It used to be a big title insurance underwriter. Their 1031 exchange company literally bankrupted what was at the time the 4th largest title insurance company in the country. Because Land America Exchange was taking this money and they were keeping the interest. So they were not only charging a fee for the service, but they were also keeping all of the interest that they were accruing. And what they were doing is they were chasing interest rates because the more they got, the more they made. So they weren't putting it with a boring bank with a boring interest rate. They were investing in something called an auction rate security. It was like, think of like consumer debt that's packaged up and sold to investors. Car loans, stuff like that, credit card debt. So they went, well, we could get, 2.5% with Wells Fargo, but boy, we can buy these auction rate securities and get a 4.5 or 5% return on it. That's even better. And Land America Exchange was a huge company. So we have 112 million on deposit. They probably had $500 million on deposit any given night. You add up 500 million times 4.5 or 5% interest, it is a god-awful amount of money. But then the economy turns. So now you have to sell these auction rate securities at auction, an auction rate security. So there had to be a buyer pool there to liquidate it. Otherwise, you just have a piece of paper that says, I own these securities, but if nobody wants it, it's just a piece of paper and you're going to get paid off over a long period of time. So what happened was they couldn't sell them at auction. Meanwhile, their consumers were saying, hey, I need my money, I'm ready to buy this replacement property. So the parent company, TransNation, or Land America TransNation, the insurance company was having to take their retained earnings and basically say, okay, here's $100 million of cash and we'll go ahead and take those auction rate securities. But the market continued to crater, so then the title insurance company was making less and less, and ultimately they were losing lots and lots. And they basically deployed all of their cash trying to make 1031 investors whole, and then they had to file for bankruptcy, and then Fidelity bought them. So it could have ended worse than it did. But I know people that lost money because they used Land America Exchange and they did not get back 100% of their funds.
So the only people you answer to at an exchange is the exchanger and then whatever the market's doing?
Well, what do you mean by the market? What the market's doing? Yes.
If you can get caught with your cookie and your hand in the cookie jar, I mean, who's really regulating you?
Don't want to make.
I have to be licensed through the Idaho Department of Finance, and I have to carry a $20,000 surety bond. And I have $112 million on deposit. It's terrible. But the federal government has basically said, your industry isn't big enough for us to worry about regulating. We're just not worried about it. During the recession, I bet you, let's say between Land America Exchange, another company out of Vegas called Southwest Exchange, and another group out of Florida called 1031 Tax Group, right? These are not places where good things happen, Vegas and Florida. I bet you add it all up, there was probably $500 to $800 million of investor money that just evaporated. It went away through embezzlement. And the federal government looks at that and thinks, that's just not enough for us to worry about. We don't care. I mean, you guys figured it out. So some of the states have come in and put regulations in place. Idaho did what they thought they needed to do, and that's great, but it's still underwhelming. So I can tell you, we have lots of insurance. I have a $2 million Fidelity bond per occurrence, and every file, because it's a segregated interest-bearing account, every file is per occurrence. We do have limits on it. It's 20 million in total, but I also have an accounting department. It takes 4 people. Well, it takes 3 people in my company to move money, and then there's a 4th person that reconciles it every night. So they make sure that they know everything balances.
Yeah.
I could steal money, but I would have to collude with 4 people and we'd get away with it for maybe a week.
Yeah, now that's when I wasn't like, thinking.
No, it's a good question.
Yeah, for some reason it seems weird that all this money
It is weird.
exchanged and nobody's, don't worry about it, that we trust the guy.
I can't tell you how many people sell sizable assets. I mean, millions of dollars gets wired from a title company in California up to Boise, Idaho, and they never call to confirm. I mean, we communicate, we send off communication saying we've received your funds. People, they just are like, yeah, I guess this is how it works. Our money must be there. And I promise you that there's companies that aren't as well insured as we are. Lots of them.
Yeah.
So if you're gonna recommend an accommodator, make sure it's one with a lot of financial horsepower. Intermediary is me, Likekind requirement, let's never use that term. Multiple properties. Can you sell one property and buy multiple replacement properties to spend up your money? Yes, you can. Perfectly okay. Likewise, Can you sell multiple single-family rentals and consolidate the proceeds to buy one large commercial property? Yes. It's just an issue of timing. Can you get it all done within 180 days? Right? If you're selling a big one for 10 million and you want to buy 10 replacement properties, can you do it within 180 days? Can you get everything closed and spent within 180 days? Likewise, can you sell 10 single-family rentals and close all of them in time to perform on the purchase of one large replacement property? Because once you buy a replacement property and take title to it, you can't then use additional 1031 money to continue to exchange into it. Once you own it, we're done. Once you're vested in title, you don't get to continue to exchange in it, or you don't get to continue to make improvements to it. You're done.
Is there such a thing as a reverse
There is.
exchange?
Yep. And I will cover that one separately.
Oh, okay.
We'll cover that towards the end. Reverses are it's a great way to go if you can pay for them. Like if you have deep pockets, I like reverses a lot, especially in a seller's market right now, because it allows you to shop first.
Right.
You wait for the right investment. When it presents itself, you move on it, you close on it, but the taxpayer doesn't buy it, the accommodator does. This is a situation where my company actually takes title to the replacement property for the client. We use our client's money to buy it, and then you have 180 days to focus on disposing of or selling your old property. So it's just same time frame, just in reverse. We're not selling and buying, we're buying first and then selling. And I'll cover that a little more in depth later on. Relinquish property is easy. So a tax advisor is not you, I'm not your broker. If I were, I would tell you not to give tax or legal advice. If you're wrong and your client suffers damage because of it and you're sued for it, your E&O carrier will not provide any kind of a defense for you because you acted outside the course and scope of your employment as a realtor. So you are individually liable for any really bad tax or legal advice you provided. And you don't get paid for it, to be perfectly honest. You're not trained for it, you don't get paid for it, so I don't know. I mean, I know you want to be helpful to your clients, but their tax questions need to go to their CPA, and their legal questions need to go to their attorney. All right, we'll take a break, and we'll start up again in about 10 minutes. And for those of you, there were a couple of you that didn't write down your license number. If you can look that up and then come up here and go ahead and fill it in, that way I'll have it for the real estate commission when I submit this.
So how does an accommodator charge? They charge by the value of the property, or you just have?
That's how we do it. It kind of, it's a little all over the board. So you take a large, like a Fidelity exchange company, they're probably going to do a flat rate fee of like, let's say $750 up to $1 million, and if it's above $1 million, then maybe $1,500. But they're going to keep the interest. We tier it, so it's 0 to 250, 250 to 500, 500 to 750, and then we do it even differently. So let's say that we would normally charge $750. We're only going to charge $450 when you sell, and then we charge the $300 difference if you successfully purchase a replacement property. So we have to do the work on the front end, but if they don't purchase a replacement property, we don't have to do any additional work. Then you don't get charged for it. And we also pay the accrued interest to our clients. So the fee structures are kind of all over the place.
I know, because I talked to Title I and they wanted like $3,500, and I talked to 10 you guys and you know like $2,500. So it was like $1,000 difference.
That must have been it. Was it a delayed exchange? A reverse.
Yeah.
Yeah. And Title I doesn't even do their own reverse exchanges.
I know either. They recommended you. Yeah. They said, well, we can't do this.
Yeah, they don't hold title. They got bought by Title I got purchased by an underwriter called Title Resource Guarantee. It's a regional underwriter back east, and when that happened, Title I's kind of lost the ability to make a lot of their own decisions. Yeah.
Hey, I'm actually working with you guys right now with Candy.
Candy just retired.
So I wonder if I can respond to that.
Yep.
Emails, okay.
Well, your email should be forwarded. Call our the main email address is Main, like Main Street.
We're about to close with Stephanie Garner on Monday.
Yeah, just shoot an email right now to main@pioneer1031. And then but even Candy's email is taken forwarded.
Yeah.
She retired June 3rd.
Yeah, it was like, we were emailing in May and then hadn't heard from her. My last email was May 24th.
Yeah, does Stephanie Garner know that you want to do an exchange?
Yeah.
Okay.
She's in on that, yeah, on the
Yeah, then she'll contact our office and let us know. And we might already be in place. Stephanie might already have what she needs.
Okay, and then, can I just run this by you real quick? So my mom's selling a property for this.
Mhm.
There's $30,000 mortgage, and these are kind of rounded numbers, but basically.
Well, if she doesn't want to pay any tax, this is still included. The mortgage, just because you pay off the debt doesn't mean that you don't have to reinvest it,
Okay,
right? That would be mortgage boot.
yes. And she wants to keep 80,000 glued.
Okay, well then that takes care of it. Then out of that 80, 30 of it is going to be mortgage boot and 50 of it is going to be cash boot.
Okay. So she's already talked to their CPA, but I thought I heard you say something that, her adjusted basis is it's a split basis though, so it's a little bit more complicated.
She owns it with another.
She inherited part of it from her dad in 1970 something, and then part of it from her mom in 1983.
Yeah, so she got a basis on each.
Yeah.
Yeah, that's fine. You can add those two together though.
Yeah, and we never actually found out what the first basis was
When you're
from 70.
Well, when your grandfather passed, I'm guessing, did the asset go directly to your mom or did it go to your grandmother?
Grandmother.
Yeah, so your mom's basis is gonna be whatever the value was to your grandma's dad.
And then we worked this through with an attorney as well, the guy who handles their estates. Sure. So,
It was.
but if her basis is 450, it was about half.
And she's gonna pocket, out of this 911, she's pocketing 80, so that brings us down to 821.
821.
That's what she would need to reinvest to pay no additional tax. She's gonna, the 80 she gets, she's paying tax on that.
Yeah. And then she's also buying a house, cash. I know it's backwards, I know that she should. Anyway, but she's gonna buy a house cash here in Quincy.
Not through the exchange.
Not through the exchange.
Okay.
Yeah, we're gonna kind of half basically.
Okay.
Half of it is to pay the house, the mortgage. She's got to fix up her house.
What do you mean half?
Half of the proceeds.
And she's paying tax on all that.
Yeah, she knows.
Think about whether it's worth it through the exchange or not then. Because if her basis is 450.
Yep.
And she pockets, let's say $400,000 and pays tax on it,
What's that?
gets you, she's not deferring it. The other way to think about it, if her adjusted basis is 450 and all she's looking to do is buy a $450,000 replacement property through the exchange, she didn't defer anything.
Okay, that's the question that was.
Yeah, it wouldn't make a lot of sense.
Yeah, because we talked to the attorney and he said that, yeah, this was probably the right way to go, but the basis and the profit, or the basis and basically her net proceeds after her food is gonna be
Close to her basis.
close to her basis.
So she's not deferring anything.
Okay,
She recognized everything and she's not deferring anything.
but I do need to know exactly what that basis is going to be specifically.
Yeah, it helps dictate whether it's worth it to do the exchange or not.
Yeah, exactly, so I need to contact Maine and then,
Well, we can't help determine.
how do we determine basis then? Obviously through the attorney and the
CPA. Yeah, I don't know anything about your mom's tax position. So she has to look at previous tax return basically. Every year you report your assets and everything, so you just take your most recent return and it should show an adjusted basis for that property. And then if she basically says, yeah, I only want to put $450,000 into the 1031 exchange, and if her basis is $450,000, then it's a matter of mom doesn't have to defer anything. A lot of people think they can prorate it, right? They think, well, I'm gonna pocket half of the equity and I'm gonna 1031 exchange the other half. And the IRS looks at it differently and says, no, you don't get to claim half of your basis goes in the exchange and half of your basis goes to the cash that you're taking. All of your basis goes over to whatever you purchase. And we're gonna tax you on everything you don't.
Gotcha. So if I penciled it out here, she's gonna net 520 450 is the basis, there's still $70,000.
Why 520? She sold it for 9. Oh,
911, $30,000 coming right off the top.
Sure.
That's,
881.
So 881, $2,000 in closing costs, because we're just paying a lawyer.
Yeah, so 880. I mean, it's
And then she's paying out of her proceeds for.
so she's not just pocketing 80,000. She's pocketing 80 plus 280. So she's pocketing $360,000
$360,000.
that she's paying tax on.
Exactly. So that's what kind of gets us closer to this.
Okay, well, if that's all she's looking to reinvest and her basis is only 450, she needs to understand that she's only deferring $70,000 in taxable gain,
Yes. Exactly.
which is not, there's a benefit there, it's just not a huge benefit.
Yeah, 15% on.
20%, she's coming out of what state?
Yeah. She's here. I'm buying it now.
Selling in what state?
Something that I'm buying it.
Okay, yeah, and it's gonna, just 20% on 70 grand, she's not having to pay $14,000 in tax, based upon that scenario.
But I mean, for you guys, it's $2,000 to put in and take out.
Sure.
So that's still pretty
Yeah. I mean, you guys,
But then your time wise.
given the size of the sale, I don't know. If it was my mom, I would probably just say, just pay taxes on all of it.
Yeah.
You know, sell it, pay your taxes, be done with it, then you can reinvest in whatever you want, whenever you want.
Yeah.
So let Stephanie, give her a heads up on whether, we don't like getting in place for an exchange if the people end up not doing it. Yeah. Gotcha.
Do you know what California's capital gains state tax is?
I do. It's a lot more than Idaho's.
Sure.
You could pay, they just changed it, you could pay the highest rate of 13.3. On average, probably 5 to 8%.
That's probably anything under $1 million. Under $1 million, you're looking at.
Under 450,000.
Under 450.
That's an income. I just tell people in California, there's also something called the Medicare surtax, right? So when Obama passed Obamacare, there's a 3.8% surtax put in place. And there's exemptions, but you get up above 450,000, and any amount of gain that you recognize above 450,000, you have to pay another 3.8% tax on, because that's how they paid for Obamacare. So in California, between the federal government at 15%, the state at, let's say, 5%, plus the Obamacare surtaxes, you're gonna be closer to 25%. I tell people in California, on average, 25 to 28% is your tax liability.
Wonderful.
And in Idaho, it's, 18%. There's still Nate and Nicole. I need your license numbers. Nate here? Nicole? Either one? Okay.
Do you have any business cards by chance? No?
I do not. You can find me on the website real easy.
What would you recommend for our customers as far as information, like off the website, like general info or?
Yeah, general or frequently asked questions.
Okay.
I mean, this flyer is basically our frequently asked questions.
I
Just
think at the bottom of the PTC website, there's the
a link
1031,
to affiliate businesses. Yeah, you can either go directly to our website at pioneer1031.com or you can go to Pioneer Titles and then we're under affiliates. Nicole,
Yes.
do you know your license number?
Yes, I looked it up.
Okay. And whoever Nate is. I will tell you now, as we get towards the end of this and we're wrapping it up, there is an evaluation form that was part of your materials. You will need to fill it out. And I will have everybody stick it in this envelope, which will be right here. I won't ever see it, I won't look at it, I promise. So you can be as brutally honest as you want.
Are we gonna go through the accommodator pricing too?
The pricing for our fees? Yeah, you can go online. Our fees are on the website too.
Okay.
So do you have a specific question or?
Just in relationship to a 1031 exchange, I don't know how much the fees are.
Insignificant.
Really?
To be honest, is a percentage of the sales price insignificant. Like less than 1/10 of 1%.
of the sales price of the
Relinquished
original.
property.
And it's, yeah, look, the fees, and they're generally, I don't know if it's correct or not, I say generally it's gonna be under $1,000 to do the exchange.
The front and the back of it, right? The sale.
We break our fee up, so let's say the fee, I was telling this gentleman, let's say the fee on the sales price, and I don't have our fee sheet in front of me, I should know it, but my staff would. Let's say our fee would be $750. The way we break it out is we say, we're gonna charge you $450 on the front end because we know we have to do the work to establish the file and put the banking in place. And then if, but only if you buy replacement property, we'll charge you the $300 fee on the back end. If you don't successfully purchase something, you don't pay us any additional funds. And we accrue interest for the benefit of the client while we sit on the money too. So we're not like a, you guys are used to commissions and even insurance, title insurance and escrow fees tend to be around 0.7% of the purchase price, and the commissions are 6%. And we're honestly insignificant compared. They can get expensive. If it's a reverse exchange on a $30 million property and I have to hold title to a commercial shopping center and there's a gas station on site, so you got to worry about EPA and DEQ and all that kind of stuff, I'm going to charge for that. But on our average delayed exchange where somebody's just selling a fourplex and buying something else, I'd say on average $750 to $850 is probably average, which I think is.
Do you use that money to pay for those fees?
Oh yeah, it's a deductible closing cost. It's just like commissions and title and escrow fees.
One more question.
It comes out of your sales proceeds.
I had a client a couple of years that kind of called around to the different title companies and exchangers, pricing things out. It's kind of a personality. For me as a realtor, sometimes I look at, gosh, my Title I rep says, hey, we'll do the 1031 exchange for you. And then my Pioneer Title says, gosh, we'll do it, and we can do it in-house. What would be the difference between, let's say, Pioneer Title did the 1031 and then Title I did the 1031?
Insurance liability?
Difference?
Yeah.
Well, we do it better.
There you go.
Honestly, I can tell you, Title I started, they literally plagiarized my exchange documents. I mean, I know Cameron McFadden over there, he's a friend. But Title I came about long after Pioneer Title. And when, you enter the market, it's, we're gonna do Title I escrow, and then it's, okay, let's also do a 1031 exchange company, because that's what all of our competitors do. And they literally plagiarized my exchange document, which is fine. Is there a difference? Candy, who just retired, had been doing them since 1992. She knows more about 1031 exchanges. She has forgotten more about 1031 exchanges than anybody in this room will ever know. I have great staff. Bobby, who is my other accommodator, has been with me for 17 years. I have really tenured staff. I've been there for 18 years. I'd say our knowledge set is a little more polished. That's part of it. A lot of it comes down to service. We're super busy right now. We've turned clients away. Somebody said, hey, we have a rush. I need docs in an hour. I'm sorry, we can't accommodate that. Well, just move it up to the top of your stack. No, there's 10 people in front of you that we have to move up to the top of the stack. You should call Title I Exchange. And I know that they're not as busy as we are. In terms of market share, we do a lot more than they do. I know in terms of deposits, funds on deposit, we have significantly more than they do. And I think a lot of their work is probably processed locally in Boise, I think. I don't know that to be the case. It's basically Cameron and one other person. I have myself and 4 other people. All of our stuff is done in Boise. Title I doesn't do title holding exchanges. So if you want to do a reverse exchange or a build to suit, any type of exchange where the accommodator has to hold title to the property, they don't do those. They refer them out. And they refer them out actually to, I think, to a law firm in California, which I know is more expensive than we are. So having said that, does Title I Exchange do a pretty good job? Yeah, I'm sure they're capable. I have no reason to believe otherwise. I just think we do it better. And I think we offer more help too. I think if a client calls and has kind of a tax question or is looking for a little guidance because their CPA can't give them the answer they want. Either myself or a couple of my more tenured employees know the answer, and we'll provide it as a professional courtesy.
I would agree with you. I've been in those moments.
Yeah,
Either spoke with you or Bobby, or it's been extremely helpful.
Yeah, I think that Title I, Cameron's a nice guy and he's a capable attorney, he just doesn't have an emphasis in tax. And so, and I don't think he answers a lot of the questions, I think his staff does, and you just get a lot of, you're gonna have to talk to your CPA. And there's nothing wrong with that, I mean, that's fine, but if you can provide added value, we strive to. And I always try to train my staff, if you know the answer, give it to them, and I will always back you up, don't worry about it. If you don't know the answer, please don't give them the answer. Put them in touch with me or put them in touch with their CPA.
I just want to say, we use Pioneer Title to close our ranch. My folks did a 1031 exchange. They bought 36% of the property, which it was alfalfa, so it was not light type, but investment property, basically. So that's what they did. Even before my parents paid somebody else from Washington State to do the 1031 exchange, but Jesse actually has been talking to me nonstop for the last 2 years, you know, and I didn't even know that he did that, and he was basically helping me along where my folks paid this other person, and we still don't get answers from.
She was not helpful.
Yeah.
Well, it's just, you know, some are just gonna be paper pushers, right?
Right.
You give me instruction to set up an exchange, blah, here you go, these are our standard documents, we'll take your money and then you tell me what to do, but if you have questions or need assistance, you're probably not gonna get a lot of guidance.
Yeah, and ours with you, Jesse, I mean, you really facilitated making ours happen because ours was so different with the 14 acres. We had a house on it, and her accommodator kept telling her, no, you can't do it, you can't live there. Whereas when we asked you the question, we laid it all out and said, you got 9 acres of alfalfa, and that's the portion that they would like to be able to say, this is what their 1031 money is going towards. But then we also had a house, and we're all gonna live there. At that point, you said, okay, no problem. And with that, you know, with other accommodators that, and I think you talked to somebody else too, it just, not to keep patting you on the back, but to pat you on the back to say that type of service from Pioneer Title Company was something that we didn't experience anywhere else in the valley.
So it comes down to job knowledge. I mean, I can't speak for my competitors and who their employees are and how they train them and stuff, but I do this class for all of my employees, and I do it once a year. I make them sit here and listen to it just so they constantly understand the nuances of exchange. And that's, I'd like to think it's unique to us, I don't know. I mean, if we can, we've just been doing it long enough to where if you have the knowledge base, you don't mind sharing it. If you're just somebody that's pushing paper and you know, they put you in a little box and I don't know, this is all I can do. Most of my clients' questions are well outside that periphery. I mean, it's well, we have 14 acres and we have a residence on it and you know, the rest of it is a farm and what do we do? And that's where you get into, okay, well, here's how you should show it on the closing statement and break it out. It's just, I mean, it's just experience is all that is. Yes?
I just want to tell them that we get a reverse 1031 and Pioneer Title was $1,000 less cost than Pioneer.
Yep.
It's a big amount.
I like hearing that.
It's just questions I get from my clients.
Yeah, where our pricing we struggle with a little bit is because we're tiered. You get to a certain bucket, and it's like anything over $1.5 million, we just say is 1/10 of 1%. Well, we've done $30 million exchanges, right? An asset. Am I going to charge somebody $30,000? I'd love to, if they're going to pay it. But you know, the Catholic guilt eats at me, so that's where we start having to negotiate down. So I think on the really, really high dollar deals, unless you negotiate with us, our out of the box price is probably more. I don't know many accommodators that tier it that way. They're just going to have a flat rate fee of, you know, anything over $5 million is $2,500. And that's when, you know, the clients call, and if they give us the opportunity, we say, no, we're not going to charge you $30,000. You know, how about, you know, $2,500 on the front end and then $100 for each replacement property. And you just kind of negotiate. But we do pay interest, which somebody that just on a $30 million transaction, if somebody is just charging $2,500, I can promise you they're keeping the interest earned. And, 2.25% on $30 million over the course of 180 days, it adds up to a lot of money, a lot of money. Way more than our fees would have been. Okay, we are now going to skip ahead. So why bother to do an exchange? Here's some examples. I am not here to tell you that 1031 exchange is like the neatest, greatest thing in the world. It depends on the taxpayer. It's right for some people, but not for everybody. Here's an example of two people that chose different paths. So the gentleman on the left sells his 1031 exchange, or sells his investment property and does not do an exchange. So there's a $60,000 taxable gain, which means they're going to pay roughly $12,000 in tax. Okay, great. Here's the benefit. This individual now has $88,000 after tax to spend as they please, when they please. They don't have to buy just real estate. They don't have to buy just real estate within a prescribed time period of 180 days. They can invest it however they want. They can sit on cash, they can give it to their kid, they can do lots of stuff. But they're doing it with $12,000 less than the other guy. Okay, if somebody else does a 1031 exchange, they simply have $12,000 more net worth, right? I told you before, every time you stroke a check for taxes, you're decreasing your net worth. It's money that you had before, but after taxes, you no longer have it, okay? If you still have access to it, this individual is limited because they, A, have to buy more real estate, and they have to do it within 180 days. That's not easy to do. It's not easy to do. But if they're able to accomplish it, they get to use $12,000 of the government's money, interest-free, as purchasing power, right, as equity in a replacement property. And if you want to take it to the nth degree, you can leverage real estate, right? You can't, if I go buy Microsoft stock, I can't put 20% down and borrow 80% to buy Microsoft stock, right? You can do that with real estate. So that $12,000, if you want to really leverage up and do like an 80-20 loan to value, that $12,000 allows you to buy $60,000 more in real estate on the replacement property side. I'm not saying to do that, but it's possible. Okay, so in theory, this individual could end up with $160,000 replacement property or greater, which is a bigger, better asset. And this individual is left with $88,000 of after-tax money to do what they want. Now, if anybody in here loves the equities market, I teach this to CPAs and attorneys, and arguably there's a financial planner that's like, well, if I put $88,000 in the equities market, and blah, 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 that's great. Equities we should all be diversified in our investments. I don't understand the equities market at all. I don't play it, I'm not gonna pick stocks. It's a lot more risky to me than real estate. I know real estate, I'm comfortable with it, I think most people are. Most people that are selling real estate that have done well in it want to stay in it. It just works for them of, well, I did well on this, so I'm gonna do even better on the next one. And I understand that there's market fluctuation, but over time, real estate has outperformed the equities market. Oh, if you look back over 80 years, it's outperformed. But it's very subjective. What does your client want to do with those funds at that moment in time? And any answer they choose is the right one. If somebody doesn't do a 1031 exchange, I don't care. Right? We open hundreds of these files every month, so if we don't get one, oh well. Okay? Any questions on this? So, this, doing an exchange, is an interest-free loan from the government. You know what it is? It's also an interest-free loan from the government that you never have to repay upon your death. That is about the best loan I can think of. If you went to Wells Fargo and said, can I get a 0% interest loan that you forgive upon my death? That would be wonderful, right? That's truly what it is. You're using the government's money, and not only are you not paying interest on the government's money, you are getting a return on investment using the government's money. That $12,000 that you invest in real estate, If you buy a rental property and it's got a 7 or 8% capitalization rate, you're getting 7 or 8% on the government's money and you're not having to pay them any of it. That's the true benefit of an exchange. And then the ultimate benefit is when you die, you don't have to pay it back. Okay, any questions on that? That's how I educate people whenever somebody is like, well, what's the benefit of an exchange? I tell them it's a tax-free loan from the government that you never have to repay, and you accrue all the earned interest on the funds over your lifetime. Okay, history of the tax code. This is filler material. Every time I try to do this to a 2-hour module, the Real Estate Commission makes me do a 4-hour module. So, exchanges have been around a really, really long time. Okay, we've had a Revenue Act since 1918 to pay for World War I. Prior to that, there was no federal revenue tax. Okay, it was all done at the state level. Beginning in 1918, we put one in place to pay for the war, and there was a semblance of like-kind exchange. Okay, and I will tell you, soon thereafter, right, they kind of fiddle-farted around and didn't know what they were doing here, and then they took some time to get it right in 1921. And this is where we see the term like-kind exchange. Okay? And the term like-kind exchange really came around because for personal property, right? If you're selling, back then, let's say a team of oxen, you need to exchange into like-kind personal property, which would be more oxen, right? In 1924, they finally codified it, gave it its own code section. Oh, sorry, 1928. So in 1924, they eliminated non-like-kind. What I mean by that is people would sell real estate and they would buy a team of oxen, or vice versa. And the IRS came in and said, no, it has to be like-kind. What that term means is real property for real property, or personal property for like-kind personal property. If you're going to sell a crane, right? So Inland Crane is a good client of ours. Those cranes are ridiculously expensive to buy. And they're business vehicles, so they can depreciate them in 7 years. So you can buy a crane for $3 million, and you can depreciate it in 7 years. So your basis after 7 years is 0, because we've depreciated all of it, right? Well, when you go to sell that crane, because Boise's growing and it was a 15-story crane, and now you need a 29-story crane to do your work, you go to sell that smaller crane, it still has a lot of value, right? It's probably still worth $1.5 million, $2 million. So they don't want to sell it and not do an exchange because they would have to pay depreciation recapture. Okay, so people used to do personal property exchanges. You no longer can, I'll get to that later. But that's where like-kind came about. It's talking about real estate for real estate is like-kind. It's not rental property for rental property. It's just real estate for real estate. And then in 1928, they codified it under Section 112. So Section 1031 used to be under Section 112. Nothing happens for a long period of time, right? 1928 to 1984, literally nothing happened with Section 112. What did happen is a gentleman named T.J. Starker, who is from Oregon, he was doing delayed exchanges and reverse exchanges and all sorts of really exotic, sophisticated exchanges that the tax code didn't specifically allow for, but they also didn't specifically prohibit. Okay, so has anybody heard of the term Starker exchange? No, you have? So Starker to me means a reverse exchange. When people say it's a Starker exchange, it's a reverse, because T.J. Starker, from 1918 up until this point, people would do simultaneous exchanges, right? There used to be exchange clubs throughout the United States. Weiser was one of the last standing exchange clubs in the country. It was literally called the Weiser Exchange Club. All it was a broker's meeting. People would stand up and be like, I got this fourplex here, and here's what I want for it, and I'd like to pick up some property in this area, and somebody in the room would stand up and say, well, I own that, and I want a fourplex. Well, great, let's put a deal together. But they would swap deeds. It was done simultaneously. to the extent money changed hands, maybe my property was worth slightly more than the property I was receiving, and so they would pay me the difference in cash, I would have to pay tax on that. But everything was done simultaneously. TJ Starker realized that's a pain in the butt. I mean, what are the chances that I'm going to find somebody in a room that wants to swap me for what I have? So he started doing delayed exchanges. He would sell a property, touch the money. He would account for it separately, but he definitely had control of the money. And then at a later date, he would come in and use those funds to buy a replacement property. But there was a delay in time between the sale and the purchase. He was also doing reverse exchanges. He would say, well, that's a great opportunity. I'm going to buy that now. He would literally buy it, take title to it, show that he owed himself money for the purchase of that. And then when he later sold the property, he would take the proceeds to pay himself back. Right? He did it in exchange. He just did it in reverse. He sold a whole bunch of property. He owned a ton of timber ground, and he sold it to Weyerhaeuser. So Weyerhaeuser would buy these huge tracts of ground, and he would get all this money. He was ridiculously wealthy. So I'm sure he had an army of attorney and accountants telling him, yeah, let's do it. I think we got a good chance here. So what happens is in 1967, the IRS audits him. And they go in and they look at 3 years, they look back 3 years and they see all these delayed exchanges and these reverse exchanges and go, oh, good Lord, you can't do this. We want to look back an additional 7 years. So they went back to 1957 and they looked at all these transactions he'd been doing with Weyerhaeuser, and he was doing delayeds and reverses, and they just went, nope, can't do any of that. You owe us $1 bajillion in penalties, interest, and back taxes. Okay, and he didn't like the outcome, he didn't like that result, so he appealed to the Tax Court of Appeals, and he lost. And then he appealed to the Federal District Court, and he lost on the important part. And then he appealed to the Ninth Circuit Court of Appeals, which is, it's a big deal. It's like the Supreme Court of the Northwest. And in that panel, there's 9 judges at the time. He basically, the whole time he'd been making an argument of, listen, the Revenue Act, the tax code, is a contract between the American taxpayer and Congress, okay? I didn't draft it. What I did is not specifically allowed in the code, but it's not prohibited. It's ambiguous. I didn't draft it. You cannot construe the ambiguity against me, the taxpayer. You have to construe it against Congress. And that Ninth Circuit, there's a general premise in law, and that's true, is whoever drafts a contract, if it's found to be ambiguous, the ambiguity is construed against the drafter, right? The party that drafts the contract has the opportunity to get it right, and if they don't, it's their fault. So the Ninth Circuit Court of Appeals agreed with him and said, you're fine. You don't owe any of these taxes, any of these interest penalties. They awarded TJ Starker his attorney's fees on appeal, which means the American taxpayer paid for it. And that ruling came out from the Ninth Circuit in like 1981, the winter of 1981. And then the IRS scrambled and was like, oh God, we need to do this. So then they start tightening things up, right? Okay, if you're gonna do this, here's how you have to do a delayed exchange. By the way, you have to adhere to these deadlines. It opened too much of a loophole, so they had to tighten it up. And then eventually in 1990, they come in with Section 1031. So they basically rewrote a new section of the code and said, Section 112 is now Section 1031, and here's how you have to do it to be safe. Right? If you're gonna do an exchange, here's how you have to do it, or else you're gonna pay taxes. They took all the ambiguity out of it. Okay? And then we have Bush reduces capital gains from 20% down to 15%. Obama bumped it back up to 20% only for the really high earners, right? $1 million or more, adjusted gross of $1 million or more. And then we get the Tax Cuts and Jobs Act, which prohibits personal property 1031 exchanges. We no longer do work for Inland Crane Company because they can't do a 1031 exchange on personal property. There's a different code section that they added that basically here's how it works. If I have a crane that I fully depreciated and I sell it for $1 million in 2019, I have to pay recapture tax in 2019. But if I buy a replacement crane in the same year, in 2019, for $7 million, I get to deduct or expense the entire cost of that crane that year, which negates my depreciation recapture liability. So people still they're still doing it, it's not under a 1031 exchange. So, but personal property is no longer allowed. We used to do personal property exchanges for our ag clients, because oftentimes somebody is selling a farm or a ranch, and there's real property, but there's also a lot of equipment. Okay? We used to 1031 exchange that equipment separately. We would set up a personal property exchange for, the tractors and the combines and trucks and all that, and then we would set up a real property exchange for the land. And they would do a 1031 exchange into another farm, and we would use the money from the tractors, the equipment inventory, to purchase replacement equipment and inventory, and then the land for the land. Now we just don't worry about the equipment, which makes our life a lot simpler. Okay? Here are some other highlights. So we reduced the top rate from 39.6 down to 37. Okay, so a reduction in taxes at the highest marginal rate. It limits the mortgage interest deduction to $750,000 for any new loans taken out after December 14th of 2017. Any debt you had in place prior to this date, your grandfather did. And it was $1 million on the mortgage interest deduction. The big one is it limited the SALT taxes, the state and local tax deduction, to a combined $10,000, which is a game changer in a bad way. So here's what happened. These super wealthy people pay a lot less in income tax, but they don't have the deduction they used to get. Here's an example. Let's say I'm somebody on Wall Street and I own some ridiculous penthouse in Manhattan and a house in the Hamptons, and I pay, New York income tax of $1 million, and I have property taxes that I pay that total another $500,000. So I used to have $1.5 million of deductions that I could deduct on my federal tax return. That's a big deal. Now they get to deduct $10,000. So I used to be able to deduct $1.5 million, which protects $1.5 million of income. Now I get to deduct $10,000, which means I have $1,490,000 of taxable income. But I pay 2.6% less on my income taxes. It was still the wealthy got, say what you want about the change in the tax code, the wealthy people are generally got hit on this pretty bad because of this. Taking away this deduction was a big deal. And then it doubled the estate tax exemption I mentioned from 5.6 to 11.2, and that was in 2018. This year it's 11.4 and change. Okay, any questions on that, tax code changes, where we're at? I'm unaware of any other tax code changes that are coming online, but it's an election year next year, so nothing will happen, and then if we get a new administration in place, something's going to change with the tax code. Regardless of who's in office after that, taxes are going to change, and they're not going to go down. Don't ever think they will. Okay, so I'm skipping a few slides ahead. Here are some examples of boot. So there's three general rules. There's three questions, and if you answer yes to all of them, you'll never pay capital gains or depreciation recapture. Capital gains tax or depreciation recapture. Here are the three questions. Did you buy a property of equal or greater value? Right? Equal or greater value, question mark. Did you buy a property with equal or greater debt? Right. Equal or greater debt, question mark. Did you reinvest all of your 1031 proceeds? Did you spend all your cash, your 1031 money? Okay, if you answer yes to all those, you will never have a tax liability. Here are some examples. We're selling a relinquished property worth $500,000. We have $250,000 of equity or gain. We have an existing mortgage debt of $250,000. We buy a $600,000 replacement property. Did we buy a property of equal or greater value? Yes. Yes, we did. Did we buy a property of equal or greater debt?
Yes.
Yep, $250,000 to $350,000, we did. Did we spend all of our cash, all of our 1031 proceeds? Yes, we did. This is not taxable. Okay, what happened here is whatever our basis is in this property shifts down to this property plus $100,000. We spent $100,000 more than we had to. And that $100,000 is represented by the additional debt that we incurred, which is not at all uncommon. Right? So we stepped up our basis by $100,000 and there is no tax consequence whatsoever. Any questions on that one? Okay. Same property. Same property we're selling, same property we're buying. This is typically a lender-driven scenario, not because the lender's malicious, they just don't know any different, right? So in the situation, let's say that the replacement property, the lender goes, hey, you know, the historical rent rolls on that property are great, rates are really low, we have this great product. And I can loan you, easily loan you $400,000. Let's go ahead and use some leverage and that keeps additional money in your pocket, right? That sounds nice. It is, but did we buy a property of equal or greater value? Did we buy a property of equal or greater debt? Yeah. Did we spend all of our cash proceeds?
No.
Nope. There's $50,000 left over, and that $50,000 is going to be taxed. Okay, if they do not use it to buy other replacement property, at the conclusion of the exchange, it's going to come back to the taxpayer and they're going to pay tax on it. Maybe the taxpayer is okay with that, but in my experience, usually they're not. Right? The purpose of doing a 1031 exchange is to not pay tax. So they're not happy about the fact that they have this increased mortgage amount and they're going to have to pay tax. What should have happened, I mean, if the client basically says, no, I want access to some liquidity out of this, but I don't want to pay tax, I'd say, okay, you should have done a $350,000 mortgage with a $50,000. So finance what's necessary, spend all of this money, not this much, spend all of it, finance a $350,000 mortgage, and at the same time originate a $50,000 line of credit.
There you go.
Refinancing property, trading equity for debt is not a taxable event. If we were taxed on debt assumption in this country, we would not be a country. We would not exist. Okay? So that's how it works. But is everybody comfortable with that scenario? And that's cash food, because it was $50,000 of cash that would come back to the taxpayer. Okay, last example. New property, we're buying something else. Did we buy a property of equal or greater value?
No.
No, I can tell you there's a tax consequence here, right away. If you answer no to the first question, there's a tax consequence. Did we buy a property of equal or greater debt?
No.
No, so it's mortgage boot. Whatever the tax consequence is, we know it's mortgage boot. Did we reinvest all of our cash proceeds?
Yeah.
Yes, so I know it's not cash boot. There's $100,000 of mortgage boot, and it's gonna be taxed just like cash. And people don't like that either. They're like, well, I didn't get any money. The IRS doesn't care. Okay, you didn't reassume enough debt. You had a $250,000 mortgage on the old property. You only have a $150,000 mortgage on the new property, so you put yourself in a better position, and you're going to pay tax on the difference. Okay, any questions on that? All right. We've covered all this, I promise. Here is, so somebody asked about, why 2 years? Here's the private letter ruling, and I can tell you the scenario. This really nice old couple, the husband had MS. Early on, they did some planning and they realized, okay, well, we're gonna sell a rental property. They actually had like a triplex or something. They sold the triplex and they exchanged into a single family rancher, right? It was wheelchair accessible. And they held it for investment purposes. But they knew eventually the house we're in is not gonna work for my husband and we need to be in something that's more ADA compliant. So they just planned ahead. So they did a 1031 exchange, they bought a home that was gonna work for them long term, and they rented it out for 2 years. And then after 2 years, they wrote into the IRS and said, dear IRS, this is what we did. Here, we'd like to move into it due to my husband's failing health. He needs something that's more accessible by wheelchair. Are we okay? And the IRS wrote back and said, you betcha. So that's why I tell people 2 years. Now that's a private letter ruling, which means they answered a specific question to a specific taxpayer, and only that taxpayer can rely on that answer, but it gives all of us a pretty good indication of where the IRS is. Now, they didn't say 2 years is fine, and a year and a day would have worked for us too. So all I know is that 2 years is pretty good, so that's what I tell people is 2 years.
Jesse,
Yes.
can you speak to again, you said earlier you had customers like give them a call and then how often can you reside in your property?
Technically
Technically,
and legally, 14 days.
14 days.
So you can go up there Christmas through New Year's
Okay,
and 4th of July and broadcast it to the IRS. Guess where I'm staying tonight?
okay.
Beyond that, technically, it becomes a second home,
For maintenance or repair.
unless you're up there on maintenance and repair. And there's always something to maintain and repair in McCall.
I even had somebody ask me about what if they park their RV on the property?
Sure.
Because
Yeah.
that's not,
This just comes down to tax reporting. It's
Okay.
what kind of, risk assumption are you comfortable with on your tax reporting? I mean, the IRS does not know where you lay your head every night.
Okay.
It's all about activity on a tax return. I think it's unwise to exchange into a property and have it sit vacant for a year or two, and then you move into it and it just suddenly becomes your primary residence. I think some activity showing reportable income, passive rental income that's what I do. Yes?
So if you do have a second home, and whatever you do an Airbnb or whatever, these, to make money, is that rent received, so that goes on a stable lease, so
Oh, yeah.
that would avoid it being a second, how that, or even like a primary, so say it's a
Well, define it. I mean, how, you say second home, but is it, do
Well, I
you,
mean, it's clear, either.
How often do you use it?
Investment. Well, I mean, if you receive rents from it, then, what, like, you receive.
I think any rental activity showing it's held for investment purposes is really useful. And if somebody called me and said, Jesse, we use it quite a bit, but we also rent it out quite a bit, I'd say, as long as you have the rental income to justify the argument that it was held for investment purposes, go ahead and 1031 exchange it. Second homes are tough because it's not your primary residence and you can't 1031 exchange it, so you don't get a tax-free sale and you can't tax defer it. You're stuck. If you sell what is truly a second home, you have no exit strategy other than to pay taxes. Or die. That's true. That's true. Okay. I'm skipping ahead. Okay, we all know real property is not like kind of personal property. Here's examples of like kind. Ag land or unapproved land for this building. You can go from a non-depreciable asset to a depreciable asset, and that's fine. The reality is whatever your basis is in the old property is all you're going to have for basis in the new property, so you might not have much to depreciate. But if you sold land with a high cost basis and exchanged into this building and you had a lot of basis, you could begin depreciating it. You didn't have that depreciable allowance before, but you do now. That's perfectly okay, because it's real estate for real estate. Apartment building for land, single family rental for commercial, commercial for industrial. The IRS has told us, they came out and said, listen, if you have a leasehold interest of 30 years or more, we consider that to be sufficient to be considered real property. So if you have a long-term leasehold interest, you can 1031 exchange that. Happens all the time. Good examples locally would be the Idaho Department of Lands that owns all the cottage sites on Lake Payette and Priest Lake. They're selling them now, but they used to lease those, and people would be able to sell their cabin. They don't own the land, they just have a leasehold interest to use the land. They would sell the cabin and transfer the lease or assign the lease to somebody else for a bunch of money, and if that cabin was held for investment purposes, right? It wasn't like the family cabin, it was truly an investment property, at least they had rental income from it, then they could 1031 exchange that and use it to buy fee title ownership of replacement property. So we do see some leasehold interest. We see them a lot with airplane hangars. Airplane hangars, if they're at an airport, which they tend to be, they're the municipality, the city owns the airport, right? And it leases out the ground where the hangars sit, right? Nobody owns fee title ownership. If you go to Boise and all those hangars, so they're not privately owned hangars, they're leased property, and you just own the structure, you own the building, the improvement, you don't own the dirt. Well, when you sell that, the leases basically they tend to have 10-year terms with automatic renewal provisions. Basically says, if you're current on your lease, then we will automatically renew for another 10-year period in perpetuity. So you get to tack those renewal periods together to get to 30 years, and that's fine too. So we have done a number of airplane hangars where the people exchange out of a leasehold interest and airplane building, airplane hangar, and they can 1031 exchange into either a bigger, better airplane hangar or something completely different. Okay, that works. Easement for a fee simple interest, we talked about that. Somebody up in Stanley sells a conservation easement for millions of dollars. They can take that money and 1031 exchange it and use to buy any investment or trade or business property that they want, anywhere in the country, and it qualifies. And urban for rural and vice versa is fine. Okay? Any questions on those? Alrighty. Dealer and inventory. I've covered this. It's real easy if we're talking about Brighton Corp or Corey Barton Homes or Hubble Homes or Hayden Homes or Toll Brothers, because those companies clearly are developers of real estate, right? They buy property primarily for the purpose of resale. Stock in trade or other property held primarily for resale. They buy dirt to plat it, improve it, and sell it. Okay? Dealers in inventory don't get to do exchanges. I mean, they can do an exchange and they can report the 1031 exchange, but if they get audited, they're going to lose. And it's going to be disallowed and they're going to have to pay penalties and interest. Okay? So it's easy when you're talking about a true developer. But what about a realtor? You know, and the realtor that buys a home, fixes it up, and flips it. Is that inventory? Is it held primarily for the purpose of resale? You buy it, you improve it, you never rent it out, you sell it at a profit. Right? I think that's inventory. I really do. Now, do I have realtor clients that do 1031 exchanges on those types of property? Sure. People do it all the time. I mean, it's their risk. I also have clients that do it the right way. There's some properties, they know, God, I got such a good deal on this and this is such a good long-term investment. I don't want to sell it right now. So I'm going to buy it, I'm going to improve it, I'm going to put a tenant in place. I'm just going to rent it out and see what the market does. The moment you do that, you're holding it for investment purposes. You could even buy it, improve it, and sell it on lease with an option to purchase. I'm going to put a tenant in place for a year or two and give them the option to purchase it at some point in the future. And I'll just apply some of their lease payments towards their ultimate purchase price if they perform. I think that's okay. But if you're just fixing and flipping all the time, that's inventory. Probably shouldn't be doing an exchange. And it also doesn't work well because if somebody is just buying, fixing, and flipping, you run out of money just because you buy something for $200,000 and then you have to put another $50,000 into it to improve it. And let's say you're $250,000 into it and you sell it for $350,000, right? Great job, made some money. To pay zero tax, you then have to go buy a $350,000 property and put some more money into it, and it goes up in value and you sell it. There's no profit taking. So if you're doing that just for fun, it might work okay, but if you need that money to live off of, it doesn't work because your money's tied up in the exchange process. Unless you start leveraging, right? Then you go in and you're refinancing and you can get as creative as you want with the tax code. But I'm just saying, as realtors, if you're fixing and flipping, you probably shouldn't be doing exchanges on those properties. If you're fixing and leasing and holding to sell at a later date, sure, we can visit about a 1031 exchange when you ultimately sell. I don't see a problem with that. Okay? The tweeners are, you know, the working professional, the doctor that bought 10 acres just for fun and then developed it into a 10 acres or a 10 lot subdivision, and then comes to you and says, yeah, I developed this out, I kind of want to sell it, What are my options? You know, should the doctor be doing 1031 exchanges on property that he or she bought? Did they hold it primarily for resale? You know, probably, maybe not, I don't know. You know, do you want to sell 10 lots on a tax return and have all that activity? So you have 10 separate sales and 10 separate 1031 exchanges on one tax return? I don't know. I wouldn't want that kind of activity. But can that doctor, is that doctor a dealer in inventory? I mean, does that doctor have other sources of taxable income? Yes. I mean, this was just kind of a fun little investment. So is it held for investment purposes? Maybe. The way to mitigate that is instead of selling 10 lots and having 10 separate transactions, you try to structure it to where you sell 10 lots at one time. Just a bulk sale. And you don't define it as lots 1 through 10. You use the old 10-acre meets and bounds legal description. So we can help you make it look pretty for closing purposes, but that's kind of the in-betweener of, you know, is this doctor a dealer in inventory? And the answer is, I don't know. I don't get to make that determination. Are you comfortable, assuming some risk, reporting this as a 1031 exchange? And if they say yes, then they do the exchange. And if they say, well, Jesse, we want a guarantee, I say, there are no guarantees in life.
I have a question for you, Jesse. Is there any benefit or consequence to a owner of a property that's 1031 exchanging to sell the existing investment property in 1 year, but reinvest the exchange monies in the next year, like if they're
straddle tax years?
Yeah.
The only benefit is if the exchange fails and you don't receive your 1031 proceeds until the next tax year, you don't have to recognize it and report it as taxable until that tax year. Right? So the sale occurred in 2019, but the exchange fails and you get your money back in 2020. You can basically report that on what's called the installment sales method. It's kind of like seller carryback financing. You know, the sale occurred 1 year, but I didn't get my money until later, and that's when you report it
Well,
as
even if
taxable.
it doesn't fail though, and you just don't reinvest until the following
There's no benefit.
Okay.
If your exchange is wrapped up, what happens is if you sell this fall and you complete your exchange in February of next year, you just don't get to file your tax return for 2019 until your exchange is finished and you can report it. So there's no benefit. The benefit is if it fails, you get to, instead of having to report it and pay taxes on your 2019 return, you get to wait and report it as taxable in 2020, which is a long ways away.
Okay.
It's like April 15th of 2021.
Correct, okay.
Okay. Any questions on dealer and inventory? You guys are looking tired. Okay. Here are the questions the courts ask to determine whether you are a dealer in inventory. First one, pretty easy. Why did you buy it? What was your intent? And your intent, whatever it was, your answer is your answer. What do you do for a living? Do you derive 100% of your income from improving real estate and selling it? If so, you're probably a developer and therefore a dealer in inventory. If you're a doctor, you're probably okay here. Proximity in time between the purchase and the sale. Did you buy this 2 months ago and immediately do all this work and improvement to it just to sell it and make a profit? If so, that doesn't look very good. Have you owned this for 10 years and been farming it as a hobby farm? Okay, then it was obviously, up to this point, it's been held for investment purposes. So it's really, how long have you owned it? And that goes back to, you know, why did you buy it? These are really tied together. This is a big one. The extent nature of improvements you made to the property. Let's take mom and pop in Meridian, Idaho, and they have 80 acres that they have been farming, but they are now surrounded by rooftops. Okay? And so they have a long-term capital gain asset because they've owned it and they've been farming it for years. Their basis is very, very low. You know, they bought this farm back in the 60s and they paid $300 an acre. And they know that if they get a preliminary plat or they get it annexed into the city, they can probably sell it for, you know, $85,000 to $120,000 an acre. So they have a massive gain. So mom and pop, they don't want to sell the farm as a farm because the highest and best use is for development.
right? If they sold it as farm ground, they're gonna get $7,000 to $12,000 an acre. Well, that's not what they wanna do. They're surrounded by rooftops and they're already in the city limits and there's sewer and water that they can tap into, and it's just prime for development. So they know, okay, we need to maximize the value of this. We don't wanna sell it as it is right now because we wanna get preliminary plat approval. We wanna get our density up. If this property is currently zoned in ag, we wanna get it to residential development zoning. Like, 4 units per acre, whatever the density is. So mom and pop hire a civil engineer and a surveyor. And they go out and they just do a boundary survey of the property. Right? So all we're doing is surveying the boundary. There's like 4 stakes that we have to put in the corners. And then the civil engineer comes up with a preliminary design. And then you submit that to city council or the county, P&Z. Basically say, I would like to subdivide the property and here's what it would look like. It's a preliminary plat. And then they say, you know what, yeah, the density's good, it looks all right, the open space is right, it meets our criteria in our master comp plan. We accept your preliminary plat. Now mom and pop have something that they can go to a developer and say, listen, this is turnkey. This is your subdivision, this is how many lots you get out of it. Do you want to buy it? But it's no longer ag value, it's development value. That's where you get up to, 85 to 100, whatever people are paying per acre now for development ground. So here's the difference. If at that point in time, mom and pop get greedy and they go, well, that was easy. I'm gonna go to final plat approval. To get final plat approval, you have to put in all of your infrastructure. Sewer, water, power, roads, curbs, gutters, all that fun stuff. So up until the point of preliminary plat approval, mom and pop are still actively farming it. Because we haven't done anything. They surveyed the boundary, that's it. There's no improvements that were done to it. The moment they move to final plat, it changes things. They're no longer farming it, and I think they just became developers. They became dealers in inventory. Worse yet, they took a long-term capital gain asset and turned it into something that would be taxed as ordinary income when they start selling lots. So they took their tax rate from 18% to, could be 44.8%. Right? The difference between long-term capital gain versus ordinary income. If you're a dealer in inventory, it's ordinary income. Okay? If mom and pop never went to final plat, they just sold the preliminary plat, they're fine. They never made improvements. There's no physical improvements they made. The developer bought it and came in and made all the improvements, but they didn't. The moment you start putting in infrastructure and doing the things that developers do, I think you became a developer. I think you're a dealer in inventory. And we deal with that scenario all the time. And what I tell mom and pop is, do you have a huge appetite for risk? No? Then don't be a developer. Because when they go to put in to get to final plat, you have to make all the improvements before they accept the plat and record it. Well, they're gonna have to get a pretty sizable development loan. So now they're assuming a sizable amount of debt. And let's say that the market happens to flatten or turn. And they now have an asset, they can't farm it, right? They don't have crops to sell, they're not making income that way. How are they going to pay the debt service on this development loan on a subdivision where the lots aren't selling? A lot of people lost property to banks during the recession. A lot of people just decided, my land is worth a lot, but I don't want to sell it to a developer who's going to make a bunch of money. I'm going to develop it myself. I mean, I know people that got in that game and it did not turn out very well for them. So now when people mention it, I go, you do what you want. Do you have a huge appetite for risk? No, God no, who does? Developers do. And if you don't, don't be a developer. It's like when people say, should I carry back financing? I'm selling a property and somebody asks me to carry back financing and I say, are you a bank? No? Then don't be a bank. Now if somebody wants to carry back financing to kind of defray their tax liability over a long period of time, that's different. If you want to be a bank, great. But if you're not a bank and you don't want to be a bank, don't carry back financing. Okay, somebody had a question? No? We're good? Okay. All right. Let's do a quick, what do we have? I gotta get you guys out of here because they have another class coming in here at 1. We're gonna break until just before about 11:50. And then we'll finish up the last hour and I'll get you out of here about, I don't know, 12:45, 12:50.
Don't you play the phone?
Over there, no.
hot in here? Change it, it was cold, really, it was cold. From the I'm sitting by the fence.
Oh,
So I would change.
it feels cool out here and you walk in here and you notice things feel like.
It's kind of warm.
It's kind of warm. Wow, we're set for 677. What's in the bag next to him?
It's like little antenna butters.
Chapstick, I think.
Chapstick.
Oh, well, in that case, yeah, I'll take a chapstick.
I'm thinking of the boys will throw them at each other.
The boys will throw them at each other.
Yeah, I think somebody just mentioned it was getting warm, but it sounds like the AC just kicked on, so we're okay. Down a little bit? Yeah. Well, I hear the AC blowing now,
Yeah,
so we should be all right.
it'll help. When that big cold.
I turned it down from 72 to 70, so.
That'll work.
Oh, you did? Nice. That's my dog. Picture.
this handout accessible on the website at all?
No. It wouldn't make sense to a lot of people in the general public. There's just a lot of speaking behind some of the slides. Okay, we do have everybody back. This is a good time. You guys can start filling out your questionnaires just so you haven't finished. And remember, you can put them in this envelope on your way out. I also have everybody's certificates, those of you that are here. I'm going to put them right here. So when you head out, and if you came here late and there's not a certificate in your name, I think towards the back there's a few blank ones you can just kind of write your name in. And again, if you have not already done so, we'll need you to give me your license number up here. Looks like we got all of them. Never mind, I think we're good. All right. So those that were registered, yours will be here. Those that, there was 3 of you that came a little bit later, you can just write your name in here and we'll be good to go. Okay, we'll get started again. Now, in a 1031 exchange, you need to generally understand that there's something called the same taxpayer requirement. So how you start the exchange as a taxpayer has to be how you finish the exchange as the same taxpayer. Now there's a lot of variation to that. It's because, let's say my wife and I, if we start an exchange in our names, it's very easy. We have to purchase replacement property in our names. But what if we're buying commercial property on the replacement side and the bank says, Jesse, we need you guys to take title as a limited liability company. Can my wife and I form an LLC to purchase the property? Sure. Because that LLC, we can then treat it as what's called a disregarded entity. Just because you form a legal entity does not mean that it's a taxable entity. There's lots of legal entities that exist that do not report their own taxes. Okay? Everything is reported on the Schedule E of the taxpayer. For instance, if you have a husband and wife limited liability company that is a disregarded entity, what that means is the federal government, the IRS disregards it. It doesn't exist. It's just a matter of whatever the activity is for that LLC, it's going to get picked up on Jesse and Molly's individual return. A living trust is another good example of a disregarded entity. You know, grandma and grandpa form a revocable living trust and they put all their assets in it. That trust does not report its own taxes, right? Grandma and grandpa are reporting the activity of the trust on their individual tax return. However, if we start an exchange as a partnership or as an LLC that has elected to report as a corporation, that is its own taxpayer. So let's assume now that 3 of us in this room have an LLC, so it's not a husband and wife, it's not a disregarded entity, it is a partnership, and you're either going to file a partnership tax return, it's called a 1065, or you're gonna get a K1, which a lot of people do, and that means you're reporting as a corporation. Okay? Now that LLC does its own taxes. It is a taxable entity. So what happens if we're going to sell a property and the 3 of us, this gentleman, this woman here, we're members of a partnership or an LLC that reports as a taxable entity. It owns a property and we want to sell it. If we don't do any pre-planning and the LLC sells in the name of the LLC, which is its own taxpayer, there's no way for the 3 of us to do what we want individually. Cannot do it. Because if we start the exchange under one taxpayer ID number, but we finish it under 3 different ones, it doesn't qualify. Right? So if the 3 of us want to stay together, then we will. We'll go ahead and buy our replacement property under the name of the partnership. We sell, we buy, everything's fine. But if we want to go our separate ways, you're going to have to help your clients do a little pre-planning. So this LLC that we have, where there's 3 members, is going to quitclaim deed to you and me each as to an undivided 33.33% interest. We're gonna create a tenancy in common. We're gonna get it out of the legal taxable entity and into the individual name and individual social security number of the partner or the member. Does that make sense? And that's typically how it's done. So how you start an exchange has to be how you finish it. A lot of people have gotten very creative here and it never works well for them. Now, in Idaho, can you go ahead and quitclaim deed the property out of the partnership the day of closing and then simultaneously sell it as 3 individuals? Arguably, yes, but we'd like to see a lot more planning involved in that. Distribute it out as tenants in common. Okay, any questions on that? There's a lot of entities that, like I said, are disregarded entities for federal income tax purposes, and if so, you don't need to worry about it. The entity exists for legal reasons, not for tax reasons. Okay? Questions or scenarios or what ifs on that? No? Okay. Well, that's easy. I can almost promise you, even single family rentals, most people hold rentals in some kind of a limited liability company. You just want to ask, what are you going to do with this? If we're going to do an exchange, do you want to purchase the property under the LLC or under the family trust? And usually the answer is yes. But you need to figure out what their goal is on the front end. And if you're dealing with an entity that's actually a separate taxable entity, they need to understand that that entity has to be the exchanger, and that entity has to acquire replacement property. Unless we distribute it out of the entity to the individuals, and then the individuals go on about their merry way and do what they want. Okay? I'm going to skip the rest of these partnership membership slides. Personal property, let's go ahead to that one. You can't do it! I should get rid of this slide.
Yeah.
Okay, section 121. So prior to 1997, there was a section of the code, it was actually called section 1034. It was now known as section 121. And it basically said, if you are 55 years of age or older, and you're selling your primary residence, which you have owned and lived in for 2 out of the last 5 years, you can exclude $250,000 of gain if single, $500,000 if married, provided you buy a property of equal or greater value, right? And you only get to take this exclusion once in your lifetime. So for those of you who ever sold a home, well, I don't think anybody in here was over 55 in 1997, but if you were, and you had sold a house previously to that, this used to be a one-time exclusion, and you had to be old enough to qualify for it. The IRS got really smart, and they realized that this is going to generate way more activity in the real estate economy if we open this up a bit. So in 1997, they changed it, and they moved it from section 1034 into what is now called section 121, and it now says, if you have lived in a home for 2 out of the last 5 years, you can exclude $250,000 of gain if single, $500,000 if married. There's no requirement that you buy a property of equal or greater value. You can sell a home and pocket the money. It's not a big deal. You don't have, you can own a home at any age. I mean, arguably it's going to be, I don't know many 21-year-olds that, you know, have a primary residence selling, but some of them do. People in my generation did. Millennials, not so much. But anyway, this is the section of the code you guys, everybody kind of always says, oh, it's the tax-free sale of a home. And yeah, for most people that's what it means. But the reality is you get to exclude up to $250,000 of capital gain if single, $500,000 if married. Some people in the valley have greater than $500,000 of gain on their primary residence, and every dollar above $500,000 is taxable. You had a question?
Yeah, just to confirm, in a real estate class, they told us those 2 years, if you were a smidge below those 2 years, it was prorated. So if you were only 18 months. Okay.
You can report it that way.
Okay.
And if you don't get caught or questioned, great.
Okay.
There's no proration. I mean, it's all or nothing. You either qualify for it or you don't. You also got to remember, it's 2 out of 5 years or 24 out of a total of 60 months. So a lot of people have 2 residences, right? So let's say you live in Boise for 8 months out of the year and the desert for 4 months out of the year. Once you have accumulated 24 out of 60 months on your Boise property, you would qualify for that sale to take this exclusion. And then you can move down to the desert and live there, and in 2 years you qualify for this again. You only get this exclusion once every 2 years. You can't sell a home this year and take it, and then sell a home next year and take it, and a home after. It's once every 2 years, and it's 24 out of 60 months. I am wholly unaware of any ability to prorate. I'm sure a lot of people just report that, oh yeah, 2 years, I'm good. That's what you do. It's a box you check.
Yeah.
And then what they're saying is, yeah, I'm good. They don't prorate it. They just declare that, oh, I've been here 2 years, I'm good. And the IRS, your chances of an audit are pretty slim.
Every time of exceptions.
What's that?
Exceptions.
To what?
Like saying like a prorate deal for certain scenarios where, I mean, is there anything that you can, I guess, ask for, hey, based on this scenario?
The exceptions are, I think there's medical hardship. So if you, let's say you're rendered incapacitated or bound by a wheelchair or something, and you just can't live in the home anymore, you physically can't. That would be an exception. Job relocation, as long as it's more than 110 miles away, would qualify. Military deployment, that's about it. Those don't happen to many of us. I mean, if you're in Boise and you have a job relocation, it's further than 110 miles. Caldwell doesn't count. It's not far enough. It's not 110 miles. I mean, I guess Twin Falls would get you there. It's like 140 miles. So if you have to relocate to if you get to relocate to Twin Falls. I have a lot of friends from I actually like Twin Falls a lot. It's a fun town. Okay, so this is the exclusion people always talk about. Don't call it a tax-free sale, because it's not. If somebody has more than $250,000 of gain or $500,000 of gain if married, it's not tax-free. Okay, they get to exclude up to a certain amount. Everything above that's taxable. In Idaho, generally that means it's a tax-free sale. In California, not even close. I mean, I have clients that routinely call. They want to do a 1031 exchange, and then when you talk to them, you find out it's their primary residence. And the reason they're calling is they want to defer tax because they just found out, well, I'm selling my $3 million piece of crap little craftsman home in Malibu that I bought for $300,000 back in the 70s or 80s, and I only get to exclude $500,000. So my basis is $300,000. My exclusion gets me up to $800,000. And I'm going to have to pay $2.2 million tax on $2.2 million on the difference in California, which is going to put you at about a 28% tax bracket. I mean, it's a lot. It's going to be a lot of tax. So they want to call and do a 1031 exchange, and I tell them that, well, it's your primary residence. If you talk to your CPA, no, he told me to call you. Well, I don't prepare your return and I don't sign it. You do. But I will be honest with you. That's been your primary residence for decades. You have no rental history whatsoever, so I fail to see how it just miraculously became an investment property. And you're just going to have to pay taxes on the difference. Or, don't sell your house right now, put some tenants in place, qualify as an investment property, and then sell it and do a 1031 exchange a year or so later. And that would work. People do that.
Rent to own with your.
Yeah, at least with an option to purchase. You bet. Okay? So, section 121 in conjunction. This comes down to, let's say somebody mentioned earlier, duplex. You live in one, you rent out the other one. That's easy. That's a 50-50 scenario. A bread and breakfast is another example of it's trade or business property, but it's also my primary residence. A farm falls under the scenario too, because you have farm ground and you have a farmhouse that is your primary residence. In any of those categories, all we have to do is bifurcate the value. So somebody is paying you X number of dollars to purchase this asset, this duplex, this bed and breakfast, this farm. Our job is to allocate a value as to what is the residence worth. Okay, so if it's a duplex, and this is a true story, in Coeur d'Alene, there was a very nice duplex on the lake, and the client lived in one half and had fixed it up. It was a much nicer unit. It was the same size as the other unit, but it was much nicer. So the purchase price, total, I think was like $780,000. and they basically allocated $450,000 towards her unit as her primary residence. The balance of the funds we allocated towards the rental unit. So on the closing statement, it just says $450,000 to taxpayer for sale of primary residence. Right below it is X number of dollars proceeds to Pioneer 1031 company for 1031 unit. That's all we do is just spell it out. You just break it up. 450 goes over there, 300 and whatever it was, 330 I think came to us through the 1031 exchange. A farm is the same thing. It's, if somebody is buying, this is an 80-acre piece right here, right? And we have a house here in the corner. That house in 1 acre, and I can almost promise you that's how the tax assessor is assessing it, right? The other 79 acres has an agricultural exemption on it and has for a long time. That's trade or business property. So when we sell this for $4 million, we want to determine what is this worth? What's the house in 1 acre worth? And you want it worth as much as possible. Just like on the duplex unit, we kind of increased the value of that unit because it was nicer, and they inflated it a little bit further too. We want to make this house on 1 acre worth as much as possible because mom and pop get to exclude up to $500,000 of free money. So if their basis in the home, this is a real example, is I think it was $38,000 is what their basis in the home was, and their basis in the land wasn't much more. It was like $100,000, and it was a $4-point-something million sale. If their basis is $38,000 and they get a $500,000 exclusion, if we can, we want to try to make this house in 1 acre worth $538,000, if we can. But if this is a house in 1 acre out in Meridian at the time, it was a cute farmhouse, and maybe you get there. In this market, you could. This was back in like 2006. But if we can get there, if you can give them some kind of a market analysis or a broker's price opinion or something indicating that, I fudged the numbers and I'm pretty aggressive here, but I think we can get to $538,000. That's what we want to do. Because then at closing on a $4 million sale, the first $538,000 goes to mom and pop, and it's tax free. It's intended to help them buy another house, but we'll get there in a sec. Right, so that's $538,000 in their pocket, tax free. Everything else, if they want to, they could put in a 1031 exchange. When they go to buy a replacement property, most of my ag clients love ag. They just love dirt. They love being around land, and so they're going to buy a replacement farm. It's just going to be further out. So now we go to buy the replacement farm, and it's $3.8 million. We sold this one for $4 million, and the replacement property is worth $3.8 million. And it's got a much nicer house. They almost always have a nicer house on the replacement side. So it's a beautiful home on an acre. Now we want to kind of artificially decrease the value of that home. We don't want to spend a bunch of mom and pop's tax-free money, because it's tax-free. We want to spend as much tax-deferred money as we can. So now, on the $3.8 million purchase, even though it is a much nicer home than what was sold, we determine it's worth $338,000. So mom and pop take $338,000 out of their $538,000, and they buy a home. But they have $200,000 of tax-free money left in their account. We allocate the value of everything else to the ag land, and that's what we use the 1031 money to purchase. So when they're selling, you want to artificially increase the value of the home, and when they're purchasing, you want to artificially decrease the value of the home. We want to pocket as much tax-free money as we can and spend as little of it as possible, because we want to have as little tax-deferred money on the front end and spend all of it on the back end. Does that make sense? Okay. Any questions on section 121? Everybody with me? Perfect. You don't need to worry about any of this. Involuntary conversions. Again, this is kind of filler material. Governmental takings, that's all this is, right? This is a takings clause, but property can be involuntarily converted by a taking. It can be involuntarily converted by, flood or fire, destruction. It's more of a property and casualty claims settlement, like an insurance claim settlement. So let's say that I have a property, a rental, My basis in it is $150,000, but I'm insured for replacement cost, and the house burns down, and the insurance company gives me a $300,000 settlement check. That happens. If I don't spend that $300,000 rebuilding the structure, right? I just decide, you know what? I'm gonna take my settlement and be good with it. I'm going to pay tax on that because my basis in that property was $150,000. And let's say 50 of it went to the land. So my basis in the dirt is $50,000 and I still own that dirt. I still own the lot. My structure, I had a basis of $100,000 and it burned and I got a check for $300,000. So if I don't reinvest those funds within the allowable period of time, which is 2 years, you get a much longer period of time because you didn't want it to burn, it just did. Maybe you did want it to burn. That, if I don't reinvest in terms of rebuilding the structure or showing that I purchased other investment property with that money, then ultimately I'm gonna have to pay capital gains tax on that $200,000. It's no different than if ACHD comes in and condemns my property and they say, we're widening Overland Road, we need to take this property. And I go, well, I know you're gonna do it, let's just talk about the value, and we finally arrive at a figure and they pay me the value for my property. It's kind of like a 1031 exchange, only you don't need an accommodator. You can touch the money, it's okay. And you have 2 full years, you have a much longer period of time to reinvest those proceeds into replacement property. And that's only fair because you didn't want it to happen, it was kind of thrust upon you, okay? Anybody dealt with ACHD or ITD or, I mean, our valley is getting really active on widening roads. And every time they widen the road, they're condemning property. We do a lot of work for ACHD, and I can't tell you how many times we'll get an order for 127 title commitments in a day. They'll have a project where they're going to widen it, and then they basically are like, this is what we need. We need to know exactly what we're buying and what affects title, and so they will place a title order for all those parcels along that stretch of road. So I can tell you they're pretty active right now in terms of either condemning or just purchasing property. Boise State is really active. I mean, their campus, their growth, they're condemning property. They try not to condemn. Boise State I found to be they just overpay, which is, it's great for the sellers, but Boise State understands, God, instead of dragging this to the court process and the time it's gonna take, we'd rather just pay an extra 5 to 10% to be done with it. But I can tell you, it's not a matter of if the agency, whether it's a county or a state or a federal agency, BSU gets to do it under the Department of Education. It's not if they're gonna take it, it's really just how much they pay for it. Right? Now what they can't do is condemn your property and then turn around and sell it to a private developer. It has to be used for a public purpose. But widening roads, expanding universities, our area is pretty unique in our hospital. A lot of larger cities have county hospitals. So if they were to expand the county hospital or build a new one, the county can condemn property to do that because they're putting in a hospital which is for a public purpose. Parks qualify. CUNA had to condemn a bunch of property when they put in their sewer treatment facility a while back, 7, 8 years ago, more than that, probably 8 or 9 years ago. Any public purpose qualifies. They're gonna take it. It's just a matter of how much they pay you for it. All right. We'll skip the rest of that. We're gonna talk about reverses and build-to-suits, and then we'll kind of wrap it up for the day. We've covered all this, I promise. This is the last thing we're gonna go over. Right here. These are the rules, the identification rules. Identifying is by far and away the hardest part of a 1031 exchange. Because you only have 45 days to do it. So when somebody starts an exchange, they always say, well, how do I identify? And I say, well, we'll send you a form, and so we mail out an identification form with a nice cover letter, and it tells them how to do it, but they always call and have questions. and there's 3 different rules. Okay, there's only 2 I want you to remember. So there's the 3 property rule, there's the 200% rule, and there's the 95% rule. This one's a bad idea. People also send us identification forms where they identify under the 3 property rule and the 200% rule. You gotta pick one. These are mutually exclusive, so you pick one. Here's how the rules work. This one's very easy. You can identify up to 3 properties. Period. Doesn't matter the value, you're just limited to 3. You get to identify 3 properties. I don't care if they're worth $1 or $1 million a piece. It doesn't matter, you're just limited to 3. So if somebody says, well, you know, we're selling a large asset and we're looking to diversify, we think we're going to be purchasing more than 3 properties, okay, the 3 property rule isn't going to work. So now we're going to fall under the 200% rule. And this rule basically says, we don't care about how many, right? Over here, you're limited to 3. On the 200% rule, as many as you want. But you have to identify the fair market value of each property that you identify. So now you're listing the value, what you're willing to pay for all these properties. And when we add up all the values that you identify, it cannot exceed 200% of what you sold. So if somebody sold a $3 million property in California, they could identify up to $6 million in value here in Idaho. I don't care how many, I care about how much. The 3 property rule, I care about how many, I don't care about how much. Does that make sense? The 3 property rule is used probably 80% of the time. The 200% rule is probably used 19.789% of the time. And the 95% rule actually is used less. I've seen it used twice in 14,000 files. So if somebody says, Jesse, we want to buy more than 3 and we're crazy, we're going to leverage way the hell up and we're going to buy more than 200% of what we sold, I'd say, okay, here's your only option. Here's the risk in it. You can identify as many as you want, worth as much as you want. But you have to successfully close escrow on 95% of the value identified. So now you identify as many as you want, but you still put the fair market value down. Doesn't matter how much though. You can identify $35 million worth of property. But you have to successfully close escrow on 95% of the value identified. That is a really risky proposition because I know our industry as well as anybody on the escrow side. If everybody in this room opened up escrow with Pioneer Title, let's say this group generates 100 escrows in a month, I can tell you with mathematical certainty between 22 to 23% of those every month are not going to close. They're just going to fall out of escrow. They're never going to go to closing. So if you're identifying 10 properties worth a whole bunch of money, statistically speaking, you're going to successfully close on 78 to 77% of them, not 95. So it's really risky. I have seen it used twice. Both times it was in an agricultural setting, and farmers were kind of blocking up property, and they'd all gone to school together, and their grandpas were buddies, and it all worked fine. But if you're talking 10 arm's length escrow transactions, 2 of them are going to go bad. Maybe not, but I'm here to tell you they probably will. And then you end up successfully buying 80% of what you purchased, and you think you're fine until you realize, oh shoot, it doesn't qualify, and the accountant goes, yeah, we're going to have to go ahead and recognize all the gain. I know that you spent all your money and you leveraged way the heck up on the replacement property, but you still have a tax bill. Oops. So you got to be really, as agents, don't even give your clients the option. It's just not a good idea. Any questions on identification? Okay. Steps to accomplishing an exchange, just give us a call. This is all the stuff we do. These are the documents that we have to generate. It's basically an escrow file within an escrow. You guys are going to open escrow with the title company. You're going to instruct the escrow officer that your clients want to do a 1031 exchange. You're going to instruct them which accommodator you want to use. The accommodator is going to generate another set of escrow documents. send them back to the escrow officer with instruction to have them signed at closing. So our documents get signed at closing, just like when the title and escrow documents get signed, right? The only difference is the most important one is this one. This is the exchange agreement, and here's what we're gonna do for you. This is the agreement between us and the taxpayer. This one is, we're gonna take an assignment of your rights in the purchase and sale agreement. We're gonna take an assignment of your right to receive money, okay? We're gonna notify the other party that we're doing this. Doesn't affect them at all. I'm gonna tell you what we're doing with your money. You need to sign a W-9 and some other account setup forms because you're getting interest on your money, so the bank needs to know who to 1099, same as here. We make sure that the closing statement says what it needs to. The Foreign Interest in Real Property Tax Act, or whatever the firm did. Anyways, it's just it's paperwork. You guys are used to it. Our industry absolutely kills trees.
Yeah.
The lenders are the worst. Like a cash purchase, man, our files are, I don't know, like the 18 pages I think is what a cash purchase looks like. And then if it's a first and a second, you're financing with a first and a second, it's like this. People just sit there and their hands cramp. They have to sign so long.
Hybrid.
You do have to hybrid.
What was that?
That's the one that says, are you a foreign individual?
Oh.
It's just, are you a taxpayer and who do we report this transaction to? If you're a foreign individual, we actually deal with this a lot. I mean, our economy is very global now, so we'll have people, specifically in Coeur d'Alene, I don't know why there's so many foreign buyers in Coeur d'Alene, but you know, if they don't have a federal tax ID number, when they purchase it, property, I guess that's okay, but when they go to sell it or refinance it or do anything else with it, they have to have a tax ID number, otherwise we have to withhold a whole bunch of their sales proceeds and pay it over to the IRS, and then they have to go chase it down and try to get a refund. Reverses, okay? I like reverses a lot. In this market, it gives people the opportunity to shop first. Reverses only work really well if somebody's rich, okay? Because we're buying the new property before we have disposed of the old property. So we don't yet have the equity out of the old property. So you gotta be rich to be able to pay for the new property. Everybody with me? Okay? I say rich because you can get financing through a reverse exchange, but it's not easy. So in a reverse, somebody goes, Jesse, this great property just presented itself, I wanna buy it, but I know I'm gonna wanna dispose of something else to kind of lighten the load eventually, so I wanna do a reverse exchange. How do we do it? And I say, first things first, you can't take title to the property. Whatever's happening in your escrow right now, get the escrow officer in touch with my office so that we can make sure that we form an LLC to take title for you. If the taxpayer buys that property and takes title to it, they own it. They can't then sell something at a later date and exchange into a property they already own. Everybody nod with me because it's true. Another question I get about that along the same vein is, I want a 1031 exchange, we have a mortgage on another property, another investment property we have, and we'd like to pay it off. They already own that other investment property. I can't use 1031 money to exchange them into a property or to pay down debt on a property or to make improvements to a property that they already own. It doesn't qualify. Okay, so in a reverse exchange, the taxpayer does not take title. The taxpayer goes out and negotiates the terms and conditions of the contract, but then they advise everybody, hey, I'm doing a reverse exchange, I need help here. We form an LLC, so Pioneer 1031 Company forms an entity called a PEAT, Pioneer Exchange Accommodation Title Holder. We put a number in front of them, we're up to probably 500. We form a separate LLC for each separate client, I don't reuse them. I do that for really good legal reasons. I can tell you when Title I used to do Title I exchanges, they had one entity that held title to lots of different properties for their clients. It's a terrible idea, because if anything bad happened on one of those properties and there was a lawsuit, They were gonna name the owner of that property in that lawsuit, which would have been their exchange company. And if there was a judgment rendered against it, it would have attached to all the other properties that it owned. That was a terrible idea. We've always done, we've formed 500, we've done 500 title holding exchanges. So we form an LLC that literally becomes the buyer, steps into the shoes of the taxpayer. Now, how do we buy it, right? I work for a great company and I'm a pretty nice guy, but I'm not gonna use our corporate funds to buy a property for somebody else's benefit. I hope you can all understand that, right? We're not, like, it's not like the Bank of Pioneer. So, two types of people. I have the Ron Van Ockers of the world, or Roger Anderson is another gentleman that has done a lot of reverse exchanges. He owns the Sundance Company. If you have access to capital, they basically just go, yeah, Jesse, it's fine. We're buying this replacement property for $1 million. Here's the money. They just pay it directly into escrow. The escrow officer uses that money to pay off the seller. The seller deeds the property to the Pioneer LLC. And then my Pioneer LLC grants my client a promissory note. It's called the reverse exchange loan, but it's a promissory note secured by a deed of trust. My client basically is the lender. They loaned my LLC the money to buy this property. And then the LLC takes title. Okay? At the same time, my LLC gives the taxpayer a master lease on the property. It's zero rent, triple net, right? You don't owe me rent, you just have to pay for property taxes, insurance, and maintenance. If there's any tenants in place and you want to collect the rents on it, knock yourself out. I'm not going to deal with management of the property, we're just holding title. Okay? So we do that, we close, great. Client now has 45 days to identify what they want to sell. That should be easy, should be, unless they just own too many properties. But they're going to identify what they intend to sell and they have 180 days to successfully close escrow on the sale. If it successfully closes within 180 days, Pioneer 1031 company takes an assignment of the sales proceeds. Because I cannot have my taxpayer touching sales proceeds, that would be a taxable event. And we use those 1031 proceeds to turn around and pay the client back on that reverse exchange loan. So I can get $1 million back in their pocket on a tax-deferred basis. Does that make sense? And when we do that, they cancel the note and reconvey the deed of trust. We deed them the property. There's even a way to take the title insurance policy and endorse it over to the taxpayer, the new owner. Reverses work really, really well if you're rich, just because you can buy first and still reserve the ability to defer into it at a later date. If we add a lender, which is possible, we've done lots of reverses involving lenders, it's just a little more of a headache. Everything remains the same, it's just that there's another deed of trust, right? The bank is basically going to say, let me get this right, Jesse. So we're making the loan to Christian, but he's not giving us the deed of trust. And I go, nope, he's not. My Pioneer LLC is. We're basically a non-borrowing grantor of collateral. Everybody knows what a grantor is on a deed of trust. It's the party that's granting the deed of trust. It's granting the security instrument in favor of the lender. Christian is going to personally guarantee repayment of the debt because I'm not going to do it for him. My company is not going to give a corporate guarantee. But with his instruction, we will grant the bank a deed of trust. So now Christian has Brand X Bank involved. You don't have $1 million, you have $300,000 and you have to borrow $7. So at closing, the bank brings in $7, Christian brings in $3. We pay off the seller deeds the property to the Pioneer LLC. Pioneer LLC is going to grant your bank a first position deed of trust for $700,000. I'm still going to give you, my LLC is still going to give you a promissory note secured by $1 million note secured by $1 million deed of trust, because that's that $1 million mechanism by which I can get $1 million back in your pocket on a tax-deferred basis. So you can do it with financing. It's just that the bank, here's how the bank is going to underwrite it. We're going to assume that Christian's reverse exchange is unsuccessful. He does not sell the other property in time. Does he have the financial wherewithal to service the debt on the old property and the new property? And if the answer is yes, they'll make the loan. If the answer is no, they won't. And you guys, I cannot tell you how many times a lender will say, yeah, we have a client they will say a 1031, we're doing a 1031, blah, blah, and then they'll immediately say, yeah, we're gonna do a reverse mortgage. And there's a massive difference between the two. It's not a reverse mortgage, it's a 1031 exchange with the reverse component. But from the financing standpoint, Mr. Banker, understand, he's signing your loan documents. This is your borrower. I'm just the nice uncle that's granting you collateral on a property that we're taking title to secure your loan. You're making this loan based upon your ability to repay it and the fact that they have a collateral interest in the property. So worst case scenario in a reverse, whether it's cash or there's a bank involved, you don't successfully sell your old property. On the 181st day, we deed the property back over to you. You cancel the note, reconvey the deed of trust. It's like you bought a new property and your basis in it is what you paid for it. You still own the old property, and if and when you sell it, you're either gonna have to pay your taxes or exchange into something completely different, because you can't exchange into a property that you now own. Everybody with me? Okay, reverses are also great because you can make improvements to property during the exchange period. So let's say that the old property you're selling is $1 million. The new property that you want to purchase is only $600,000. So you want to make some improvements to it while my company is entitled. You want to spend $400,000 doing tenant improvements or whatever it might be. The reverse exchange allows you to do that, right? We buy the property for $600,000. My LLC is entitled, and then you basically go out and document all the capital improvements you make to it. You pay for them. We show all the labor and materials that are incorporated into it, so we bring that value up to $1 million, and then you sell for $1 million. We get $1 million, and we pay you back $1 million. Okay. There's also something called a build-to-suit, or a lot of people call them an improvement exchange, and it's the same thing we're talking about, but it's not a reverse. We've already sold. We have the money. They've sold the property for $1 million, and we have the 1031 funds. They want to then do a delayed exchange. They want to purchase a property, but they want to make improvements to it. They want to buy a $600,000 replacement property, but put $400,000 into it with their 1031 money, so they can have tax-deferred benefit. Same thing. When you do that, you don't take title to the replacement property, right? You're going to give us an assignment of the contract. We're going to buy it. We're going to borrow your 1031 money to pay for it. And then your contractor is going to do all the work and submit draw requests. We're going to get your approval to pay them. We're going to act as the disbursement agent and fund out on the construction draws. Spend all your 1031 money within 180 days. And then on the 180th day, deed you the property. And when you take title, you get credit for $1 million replacement property. I like those two. Those work really well on businesses that are relocating. What we typically see is a business will sell an existing real estate asset, but lease it back. So they get the money out of the sale, but they're going to lease it back for 6 to 9 months. They do a 1031 exchange with those funds. We use it to buy their new facility or their new location. We use the balance of their money to build out their new facility, right? And then when the exchange is over, we deed it over. And it's very easy. If they're selling for $1 million, but the new one's going to cost $3 million, that's fine. We only have to get $1 million done within 180 days, right? Between the acquisition and improvements, we just need $1 million. And once that's done, the exchange is over. I deed it over to you, and then your company just spends another $2 million finishing it off, and that just adds to your basis. And then when you're done, you move out of your old facility because your lease is up, right into the new one. We've done quite a few of those too for some of the manufacturers around here. So the title holding is, to me, it's simple. I mean, a lot of people, you can get a little tight around your hub, but it's pretty basic. I mean, we're just holding title. If we need to grant collateral to a bank, we do. We're not going to borrow. I've had banks say, well, you have to be the borrower. Like, why is that? Well, that's how Laser Pro draws up our loan docs. Like, why would I put my name on a $2 million loan? Well, you're part of the exchange. Yeah, I'm just holding title. Are you giving me $2 million? Well, yeah, it's being used to buy the property. I'm like, I understand, and I have a contract with my client that all we're doing is holding title. I've had lots of lenders tell me that I have to sign as the borrower, or we need Pioneer Title to guarantee the loan. Well, then my 1031 exchange fee just became $2 million. I'm not going to guarantee the loan. It's doable. It's just a matter of educating the lender on kind of the realities of it. And I've tried to do that too. I've gotten in front of a lot of the regional community banks. If you do this, Guild Mortgage is not going to, they're going to have a hard time doing a reverse exchange loan because the borrower is different than the grantor. So it's nothing that they can package and sell. Same goes on the commercial market, whether it's a residential loan or a commercial loan, you can't package it and sell it as a mortgage-backed security because of the nuance of that. But if it's a community bank, ICCU, IIB, First Interstate Bank, I mean any bank that's willing to make the loan and just portfolio it, they will. And the big banks, US, Wells, Chase, KeyBank, Zions, they'll do the loan too, but only if you're a really, really good borrower. Like private client wealth management kind of a deal, they'll do it. And literally the private client services group, they fund the loan out of their division as a portfolio loan, and they make the loan and then they open a drawer and they put it in there and they receive payments, and then when the exchange is over, a lot of times they'll just keep the loan in place. Because when the exchange is over, my LLC is deeding the property back over to you. Their deed of trust is unaffected. Their loan is unaffected. You're still going to continue to make payments on that loan over time. Right? Just because I deed you the property doesn't nullify their deed of trust. It's still there. You're taking title to that property subject to the bank's deed of trust. So, any questions on that? No? I think we're about done. I'm going to get into carryback financing because we have just a few minutes. There it is. Okay. I haven't seen a lot of carryback financing. When the market gets wonky again, and I'm sure it will at some point in the future, and people have to get a little more creative on the financing side, you'll see carryback financing. Anytime somebody wants to do a 1031 exchange, but they're also wanting or willing or being asked to carry back financing, it makes it very difficult. Because in a sale, what we're used to seeing is getting all of the net proceeds at closing, right? Every dollar you're entitled to, we're getting at closing. When you agree to carry back financing, you're getting a few dollars at closing, and you're agreeing to a piece of paper that says, I owe you the difference. So we have a little bit of cash and a piece of paper. How do we use a little bit of cash and a piece of paper? So if we sold for $200,000, and we got $20,000 down and a $180,000 note, how do I use that to go buy a $200,000 replacement property? I don't have 180 of cash. It's a piece of paper. It's got value, but it's not like it's worth $180,000 until somebody pays that for it. So that's fundamentally why it's difficult. What you need to understand in a carryback situation is not only does the $20,000 cash at closing have to come to the accommodator, but the promissory note, the seller carryback note, has to be made payable to the accommodator, right? So the money in the note comes into the exchange. And that's great if one of four things can happen. First one, it's a short-term note and it pays off in 60 days. Somebody just says, Jesse, will you carry this back? I got something coming, I'll pay off in 60 days, and I agree to it. I go, okay. So the cash and the note goes into the exchange. I go out and identify a replacement property and I delay that closing for a while. And then my note pays off. But the payoff comes to the accommodator because that's the note holder. Now the accommodator has $200,000. I can use it to go buy my replacement property. That almost never happens. If somebody is asking you to carry back financing, it's not for 60 days. Okay? It's just not. So that scenario is pretty rare. The most common scenario, the one that works really, really well, you gotta have money. You gotta be rich again. See, it's just easier if you're rich. Life would be so much easier. Van Auker sells a property and he carries back financing, right? So $20,000 goes into his exchange and there was a $180,000 carryback note, and to him that is nothing. And he was like, well, why don't I just buy that note out of the exchange? I'll just give you the $180,000 and I'll buy it. And so then I'm the note holder, and then I have $200,000 in my exchange and I can use it to buy replacement property. That's what you do. If you're rich, you just pay face value for the note. You just buy it from the accommodator. So the accommodator then has $200,000 of cash to go buy $200,000 of replacement property. Works really well. Your third option, it's a bad one, is you're not rich, and so you think, well, okay, well, why don't I sell that note in a discount to a finance company? I'm gonna go to Hopkins Finance or Pioneer Finance or JG Wentworth and Associates. And I'm glad you know who that is. But basically, I'm gonna take this note and I'm not gonna be able to get $180,000 out of it. I'm gonna sell it at a discount to a finance company that's gonna pay me maybe $130,000 or $40,000 or $50,000. I'm gonna take that cash and I'll include it in the exchange, and then I'll go buy replacement property. I will be honest, the discount that's placed on the note is probably equal to or greater than your tax liability. So why do it? You're not money ahead. It's a bad idea. And I run the finance company too for Pioneer, and I've told the gal that works that yeah, I'm not gonna ever advise people to do that because it's a bad idea. They're losing money. I know what our discount rate is, and we're one of the more generous companies. The fourth and final scenario is you pass the buck. So you basically have $20,000 in cash and a piece of paper, and you go to an owner of replacement property and say, Christian, I'd like to buy your property, and I'm gonna pay you with $20,000 cash at closing and give you an assignment of this $180,000 note secured by a deed of trust on a property that I used to own. And Christian's gonna say, that sounds like a terrible deal, I don't wanna do that. And he won't do it. And you can do it, I've just never seen it happen. So that's carryback financing. Anytime somebody talks about, well, I'm gonna carry back the financing, I almost always stop and just ask them, how rich are you? Well, not very. Then you're not gonna be able to do a 1031 exchange. But if you wanna carry back the financing to get this property sold and make the deal happen, knock yourself out, but the exchange is not a good option for you. Okay, any questions on that? Okay, with that, you guys grab your certificates up here, put your, if you would, the questionnaires in this envelope. And I thank you for your time.